27 years. Unfortunately, we are not able to meet physically. This was the case for the last class as well. And it is a bit of a challenge, as you can imagine, doing a class with or being able to physically meet up with people. But I hope we can actually move on from there, and you can make the best of it, and we can actually do the best we can. I would like to sort of understand your background as well. I know it's a bit of a challenge with doing it online and us not being able to meet to figure out who we are, but can I know whether anybody here is not in banking, or anybody outside of any financial institutions who are here? So everybody is in banking or working in a financial institution of some sort?
Majority of the people working in banking.
Right, okay. Anybody here who is already working in a treasury department or a back office, front office, middle office of a bank?
Yes, sir. I'm Nipuna here. Sir. I'm working for a back office.
Sorry, I didn't hear. Who is this?
I'm Nipuna Taranga here, sir. I'm working for commercial bank, treasury processing department, back office.
Right, fine. Thanks, Nipuna.
And I'm Bharat here, sir. I'm working for financial bank. Currently, I'm working for the recoveries department. So I'm having an idea of going to treasury department. So once I check with HR, they asked me to complete this qualification as well. So just started to do this.
Sure. Okay. Thanks, Bharat. So 2 people. I have C37 logged in.
Hello, sir.
Yes, Mohammed.
Yeah, I'm Larry from Amana. I'm working for the treasury back office.
Okay. You're with my friend Harid.
No, he's in France, sir.
Okay.
Okay, thank you.
Right. So few things. I mean, you don't need to be working in the treasury. I just asked because I'm curious to see how many of you all have a background. So nobody from the front office here at the moment who is taking the course. So I'll just tell you a bit of a background to the course and background to the sections that I'll be handling. Is the volume okay? Can you all hear?
Yes, sir. Can you?
Yes, sir.
Okay. Right. So basically, what I'll be covering is the treasury section and the ALM section of the course, which should ideally be around, I would say, about 7 to 8 sessions. Dishanta and Ms. Arjun will be also looking at the rest of the course. The objective of this section is to give you a broad understanding of how a treasury works and what the function of ALM and ALCO is through the sections that I will be doing. The other area to understand is that the course itself is designed to give you an overall understanding of a treasury department, front, back, and middle office, and with specific emphasis on how the different asset classes within a treasury department functions. I think if you look at it, it's predominantly focused on front office functions and understanding of front office functions. As mentioned by Bharat, this is one of the courses that is accepted by central bank as a precondition or prerequisite of joining into a treasury department, front or back or middle office. There are 3 such avenues that you can take. One is the course done by CBS, which is a 1-week course. The other is the ACI FMA ACI Dealing Operations Certificate, and the other one is this particular one. Of course, if you have a degree in also in a relevant field, you can also ask for special approval to join in. But these are the three most commonly used process of getting into a front back office or middle office of a Treasury Department. The purpose, and this is the longer version of it, so it is not simply a 1-week course, it's a more in-depth longer course. I currently serve as the president of ACI FMA in Asia, and also I am on the ACI Board of Education as well. So I sort of have a dual role. I do have a already pre-existing knowledge of the ACI exams as well. Have any of you all, especially the people in the Larif and Bharat, I think, and Taranga, have you all done any other exams like the ACI exams or the CBS exams already? I presume Bharat not, but any of the others have.
I'm Taranga here, sir. So far, I have
have
not done such
been done,
qualification.
Sorry, go ahead, Taranga.
So far, I have not followed such course, sir.
You haven't. Mr. Arif?
Yeah, I have been completed, sir.
You did the CBS course, no, basically?
Yeah, CBS one.
Right, okay, so thanks. So that's those 2 or 3 courses are the courses that are there, and the content in this course is more or less in the same lines, but it is more in-depth and more thorough, as you can imagine, being a 6-month course. Unfortunately, given the COVID situation, even last year's batch, we completed the classwork. We were targeting to have the exams towards the end of last year. And there was a time that we, even with COVID, we were sort of hoping to complete it by December, but as you know, things didn't really, work out the way we expected, and we ended up going beyond that, and we were supposed to have the exams for them, I think 23rd of April, and that also never materialized given the current situation. So I think that is going to be a challenge we all face, and we'll have to overcome. And if not, my objective and Nishanta's objective is to try and have these exams done, or the course completed and the exams done before the end of the year. But that all depends, unfortunately, not on you and me, but on what happens with COVID and the country's situation at that time in terms of having physical classes and exams around the physical classes itself. We would have liked to at least had revision classes that we did at the end of the year with that group physically, but we were not even able to do that. But these are the challenges we had. I hope that we can overcome this. I will just open it up for any particular questions that you all might have before I get into the main content itself. Okay, so basically, I'll start off then. You all can see the screen, right?
Yes, sir.
Yes. So like I said earlier, the course will be divided into, my section will be divided into 2 areas. First one will be on First one will be on treasury management. So what I'll try and do is treasury management, cover the treasury management section first, the first sessions that we do, and then go on to the ALM side of things later on. So when we speak of treasury management, just from an outline perspective, what is the bank's function, does the treasury do, and key factors in liquidity and fund management, etc., are areas we want to cover today. Can I ask you all, I know only 3 of you all said that you all have any sort of ground experience in terms of treasury. Before we start off, or to start things off, can somebody sort of give me an outline as to what your understanding of a treasury department is? Just very briefly, in your own words, what do you think a treasury department is, or what do you think treasury is? Forget the word management. What do you know of a treasury department of a bank?
They are the people who
So you can say it is the heart of the.
Sorry, one at a time. Who was that?
I am Bharat speaking.
Bharat, yes, go ahead.
Yeah, treasury, the process where the bank's assets and liabilities are managed, and bank's asset will be invested in various in profitable places, and they will earn profit for the bank. That is
Okay.
clear.
Right, and then okay, who was the other person? Thank you, Bharat. Who's the other one? Spoke.
So we can say that is the heart of the bank, where the assets and all the liabilities are managed.
All the, I didn't get the last bit of what you said.
All the assets and liabilities are managed where.
Okay. All right. Anybody else?
So Tharanga here, sir. Apart from the asset and liability, what we do in a treasury is managing the foreign currency exchange position and doing investment in secured derivatives like treasury bills, bonds, and all such operations. As previously said, it's the heart of the bank, which consists almost more than 40% operations of asset and liability and all those things.
Okay, thanks, Tharanga. Anybody else? So all of you are right in some form, and it is correct. Basically, everything that you said is in part correct. In traditional banking, and in Sri Lanka, Treasury is the old name used for the department in the bank that manages the bank's risks when it comes to its different asset classes that it deals in. So when I say asset classes, I'm referring to predominantly interest rates products and as interest rate related products and foreign exchange related products. You also get commodities as asset class, but in Sri Lanka, we don't really do too much of commodities, but in the more developed markets, you get commodities as a asset class. So a treasury department usually manages the risks the bank has, or any corporate for that matter. It could be a treasury department in a corporate, it could be a treasury department in a different financial institution, NBFI, basically manages the risks arising from the management of that or the the bank maintaining and working with those asset classes. Now we refer to treasury as treasury, but I think it was Mr. Larif that said that it manages the bank's interest rates or investments and so on. So treasury per se in the bigger institutions has been broken up into two areas, which is basically one area being the treasury and the other one being the global markets section of the bank or institution. So the treasury section, you're 100% right, manages the assets and liabilities of the bank. So what we call the balance sheet management, asset and liability management section of the bank is traditionally the treasury section. And global markets manages the sales and trading related to those asset classes. So for example, if I am a foreign exchange dealer who is buying and selling, say, dollar rupee or any other foreign currency, I will be part of the global markets team that manages that risk for the bank as well as for the clients that we deal with. So in the broad institution, Treasury, our global markets are two areas. Basically, a Treasury department is referred to in two areas, which is Treasury and global markets. In Sri Lanka, when we say Treasury, we mean all of that usually put together, because market is relatively not too complex and smaller. The word is used loosely to refer to a Treasury department of a institute as it is. Now, the other aspect of Treasury is, which I think was mentioned also, is that it is a, can you, somebody said it's the heart of the bank. Why do you say that? Because 40% of the risk. Now, leave aside the percentage, because depending on the institute and depending on the size of their balance sheet, that profile could be kind of different, more or less. But leaving that out, what is the objective of a Treasury department? Very briefly, one is managing risk. Olamed said that. Other one is what?
Managing banks' assets and liability portfolio while doing the best practices.
Yeah. So what do you mean by best practices?
Best practices as in doing operations smoothly without making losses to the bank as well as to the shareholders of the company.
Okay. But if I tell you that the Treasury is allowed to make losses, is that a correct statement?
Yeah, some instances there are losses, but what the Treasury do is they are trying to maximize the profit, maintaining a good practices like doing reducing losses.
Okay. All right. Anybody else with an answer?
So liquidity management is a very important part.
Very good. Yes. Thank you. Anybody else? Okay, so you're all right. Let me put it in simpler terms. Treasury has two functions. One is to manage the risk for the bank, and the other one is to make money. Simple as that, right? So risk meaning that, like was mentioned, whenever we put on an asset or a liability, or deal in a product or an asset class of some sort, there is a risk to the bank. If I am an importer, if I am a bank that's looking to buy foreign exchange to sell to my importers, I take the risk that the exchange rate will fluctuate. That's the risk to the bank. That risk needs to be managed by somebody. That is managed by the Treasury Department. And like mentioned also, there we have to do it, or the Treasury has to make sure that it's done with the minimum impact to the institution, negative impact to the institution. That's one. But it's not just about managing risk. It's also about making money, making profits. So in the process of managing the risk to the bank, there is also a profit element. So it's a profit center. It is not a cost center. So it has a target, a substantial target of the bank. And in the process of managing this risk, it has to make sure that they manage the profitability to the institution as well. Yeah. So and then that managing risk, that managing objective, is it limited to only the bank, the assets owned by the bank? Question is, when we manage the risk and make profits, are we doing it only for the bank itself?
No, sometimes like merchant forward contracts, bank support commercial companies for minimizing their risk.
That's right. So exactly right. So basically, this risk management and risk management part of it, we take it to our clients as well, the bank's clients as well. So that's why if you look at the global market section of a bank, you have a trading desk and you have what we call a corporate sales or sales desk or institutional sales desk. The institutional sales desk will look at the risks that is there on a client, one of their clients, company, and say, okay, Mr. Importer, the exchange rate is going to probably change in the next 6 months. Do you want to manage your foreign exchange risk by, you know, buying dollars now in a forward contract, doing option, managing your interest rate risk by doing interest rate swap, etc., etc., etc. So that risk management or support that is given by the bank to its clients with the objective of a value addition to the client's services, and B, also as a means of making profitability by doing by giving the client a product and, you know, having a margin and having a thing on the product, and also C, it is also a way of offloading the bank's own risk with the client, because that way, instead of depending on, say, liquidity coming from the interbank market or from counterparties in the interbank, it also, the clients that the bank deals forms a form of liquidity for the bank to operate in as well. Okay, any questions so far?
No, sir.
So it's small concern. Sir, when it comes to a developed market, they are doing trading commercial commodities. No? So
Yeah.
when it comes to Sri Lankan context, we are not doing such things. So my question is, what is the difference of that particular two instances other than the commodity? Is there high risk or low risk?
When you say two instances, not doing commodities and doing commodities, is it?
Yes, yes, exactly. Yes.
Okay. No, all right. So for example, let's take commodity. Let's take gold as an example. Yeah. And let's take a company in Sri Lanka who deals in gold. Give me an example of a company in Sri Lanka who deals in gold. You say jewelers or leasing companies. Jewelers.
Mahal, Vogue.
Yeah, one of those guys, or even a leasing company that lends against, not leasing, a financial institution that lends against gold.
Yeah.
Right now, whenever they take the gold as a security and lend against it, right, they are subject to the volatility of that gold price moving up and down. Correct?
Yes.
So we say today a sovereign is, I don't know how much is sovereign, 90,000 rupees or whatever the price is of a sovereign. Suddenly sovereign price, and they lend against 80% of that. They have a security. Sovereign suddenly goes to 50,000. Extreme case, right? Not because of anything else. Could be because the exchange rate movement. Could be definitely more to do with the gold prices fluctuating. Yeah. So if those things happen, then what's going to be the situation? They are unhedged right now. In a developed market, if that was happening, that person could go to a bank or a commodities trader or somebody and say, look, I feel gold prices are going to come down. I want to sell the gold assets I have in the future and lock in my prices that I can sell these assets at. Or we say, I feel gold prices are coming down in the future, so I want to buy more gold assets or futures or forwards or whatever you want to call it, for the next 6 months, preventing any hedging against anything. So any adverse movement against his own position. Now the question is, he can do it in two ways. He can do it as a physical, and most likely he can do it as a over-the-counter derivative or as a futures contract. Now the only difference between Sri Lanka and them is accessibility, where they can access those markets easily. So if you're in Singapore, or if you're in Hong Kong, or if you're in one of the other markets, you can actually go to an exchange and hedge against it by going into the futures market and actually dealing in the futures market and hedging against your risk. Locally, what happens is, if you don't have that product, you are always running the risk that the price will fluctuate and it will go against you. So yes, those people have an open contract, which can work for them or work against them, depending on the movement of that commodity price. What they could do is, if they have approval, they could go out and trade on an exchange, whether it's oil, whether it's gold, whether it's one of the copper, could be cotton, whatever those soft or hard commodity that you are dealing with, you can access a commodities exchange and basically deal in the futures market to buy those commodities and prevent the movement in commodities. So, for example, if you are a fabric importer and you are buying fabric and you are subject to the price of cotton moving, you could go to an exchange in New York or wherever it is and say, look, I want to buy cotton futures and prevent and hedge against the possibility of cotton prices going up and affecting your business. For that, you have to basically have access to that exchange. You have to keep, certain amount of collateral or whatever it is and deal on it. It's not that easy, but it can be done. So it's the ease of doing it more than anything else. And also you have to get special permission, I would think, because unless you're a client who's already dealing in those countries, and probably there are a few clients who have permission and doing this offshore already, but you can't do it in Sri Lanka, unfortunately, not as an over-the-counter derivative.
Right. Hello.
Yes.
So another small thing. So
Please,
when it
yes.
comes to cryptocurrencies like such derivatives, do foreign banks do such derivatives transactions like
So
Bitcoin?
Yeah, okay. So let me answer that question by telling you first that it's a new thing that's basically getting very strong popularity around the world now, as you know.
Yeah.
Now cryptocurrency is changing the way that people think about finance and think about money and think about how things move around. It's very new. Like I told you earlier, I'm part of this ACI, and we also have a working group that sort of looks into crypto and what they do, etc. But I can't pretend to understand how it works, very honestly. It's something that is very new even to me. But one thing is, it is definitely around the trading mentality, how it works, all is typical to any sort of trading environment of any other asset class, whether it's fixed income or conventional foreign exchange. So the question around whether banks are dealing with it, I think banks are just getting around to understanding it as setting up different desks that deal with it. For example, I was reading the other day that Goldman Sachs and JP Morgan and people like that are actually now looking at putting up desks and looking at how crypto can be used in conventional e-commerce now going forward. So there is no active trading. So when I worked at HSBC, for example, we didn't have a cryptocurrency desk. This is a few months ago, basically. They didn't have a cryptocurrency desk there. But then some of the American banks were definitely looking at it. Some of the other banks are also definitely looking at it. It is not only, cryptocurrency is not only about e-commerce, it's also, I think people are using it as an investment tool now, and looking at a store of value also, not just for, buying Bitcoin so that it can be used in future for commercial purposes only. There is some sort of a thing like people would buy gold and hold on to gold thinking gold prices will go up, not necessarily because they need the gold. I think that aspect of it also is coming into the crypto world. I think the challenge there is that it's not regulated. And because it's not regulated, there is always a high risk to how this will sort of, if there is something that happens that is adverse or against the market, how and who will basically be responsible for that situation at one given time, because the risk is shared amongst millions of people around the world who maintain these ledgers, and it's not really one person or one institution. And also there are also these concerns. I think Central Bank of Sri Lanka also issued this recently a circular around where the source of funds are and how it works, etc., etc. But having said that, in developed countries, it is definitely getting more and more recognition. More and more people are trading in it. More and more coins are coming out every single day, and the acceptance around what this can be used for. I think it was Tesla recently. Elon Musk said that you could buy a Tesla using Bitcoin in the future. So the acceptance around what these coins can be used for is increasing by the day. And with that acceptance, I think you will have a situation where it will slowly sort of be incorporated into the conventional banking system. I think the answer that people don't have is how is this going to be regulated, and that might be a concern going forward on the regulation of it and all that. And that's one of the reasons that you find that the volatility in that market is so high, because there is no regulation, there is no intervention. When it goes higher, it just keeps going and going and going and going, and when it goes down, it keep going and going. So for example, I think a few days ago, Bitcoin was something like 63,000, 65,000 at peak. Last week, end of last week, it was something like $50,000. Massive volatility in the currency, right? So like that, it is volatile, it is higher risk, but return can be high if you're on the right side of it. But like I said, it's not regulated and it's very risky. And where Sri Lanka is concerned, I think there are restrictions because of the possibility of foreign exchange restrictions, etc. In developed markets, people do get in, and with the current technology that we have with smartphones and apps and platforms, etc., it's easier to access those markets. But it's a very much uncharted territory at the moment. At least it's been around for a while, but it's becoming more widely accepted. And with that acceptance, I think people are trying to understand what it's all about, but it's still very new. So it's not something that local banks, I think, will be doing in the near future. And the foreign banks and the international banks are just getting into it. So I think in the next 5 years or so, it'll definitely have a presence. But for the moment, it is not part of the conventional trading arms or the sales arms of the banks, at least of the banks at the moment. But like I said, in the next few years, if it keeps on with the popularity it has now, it will definitely be part of that. So for example, if you look at Bloomberg, just to complete that, if you look at Bloomberg app or on their website, they have a separate section on cryptocurrency. Because that means people are studying it and people want to know things about it, etc. So they cover a separate area on it. So like everything else, over time it will pick up, and I must say, I think it's here to stay. I don't think it's something that's going to go away, but in what form it will stay is still something that we need to wait and see what happens there.
Okay, sir. Thank you.
Okay, so I'll just move on. I think we've covered some of these areas, but one of the objectives of the lesson, this particular lesson, is to recognize the role of Treasury and things that basically have impact on our fund management, how liquidity is important to the bank, and recognize the role of the central bank in this whole process. So what is Treasury? It is a financial center of an organization. We already discussed it in brief. One of the main objectives of a treasury is to manage the bank's assets and liabilities and make sure that it is managed in the best way possible to maximize profit for the bank and also safeguard its shareholders, the risk to the shareholders, and make sure that the bank is headed in the right direction without any without massive risks to its own portfolio and its client portfolios. So there's a brief introduction here of what the bank's function is. So I'm sure you all know this. Basically, the primary function of the bank or traditional function of the bank is to accept deposits from its depositors, and then basically serve as an intermediary and lend those funds to a person who wants to borrow money and doesn't have a means of doing it. The bank serves as a person who links the depositor with the lender and serves as a place where this whole function takes place. So if I were to ask you a very simple question, why doesn't a depositor go direct to a lender and lend the money to them? Why do we need a bank?
This because all the depositors and lenders cannot meet each other because they are not in a position to meet each other. Other than that, there should be a proper management of funds, and the banks do the intermediary part.
Okay, that's correct. Any other answers?
Main thing is the interest. If we get loan from the some other places rather than the banks, the interest rate are very high. So for the interest concern also, that is yes.
Okay, right. Okay, next one. Anything else? Anybody else?
The trust is required.
So banks are regulated.
Banks are regulated. Okay. Somebody else was trying to speak as well.
Between those two parties,
I'm sorry, I can't hear you if you don't mind.
Usually there is no trust between borrower and lender, so bank intermediate and build the trust between them, and both parties are trusting the bank.
Very good. Okay, thank you.
Banks completely.
Anybody else? Yeah, so basically, sorry, go ahead. Yes.
To minimize the risk element in all in transaction.
Yes, correct, right. So basically, all of you all are right. I mean, it works in many ways. So practically, physically, putting everybody in one place and trying to figure out who's lending, borrowing, it doesn't happen. Banks basically have this unique position where they will take the depositors' money, they will pay them an interest rate for that, and they will then on-lend that money to a lender who doesn't need to know who the bank depositors are. He just needs to know that the bank will give him the money, and his contract is with the bank, not with the depositor. Same with the depositor, his contract is not with the lender, it's with the bank. So they serve as intermediary. So what matters is the quality of the bank, how they manage their risk. Of course, like somebody mentioned, the interest rate that is paid or charged by that bank. And basically the quality of the bank's management of assets and overall name of the bank concerned, especially if you're a depositor. Now, why do people allow this to happen? Is, like you said, simply because at the end of the day, if there's a risk, for example, if a borrower, if a depositor gives his money to a third party without knowing who he is, he always runs the risk that he'll never get his money back. And he might get a higher interest rate because he's taking a higher risk, and he might be willing to do that. And the bank might pay him a lower risk, a lower rate, or whatever. But in the case of putting a deposit in the bank, you're pretty sure that you're going to get your money back. And then you're willing to compromise on the interest rate in order to get that money back. If you are a borrower, you might be paying a slightly lower interest rate as well, because you are getting it from a bank who has in turn got it from depositors who in turn they pay a relatively lower interest rate too. So this function is a unique function, and this is why, I mean, going back to this Bitcoin matter as well, where sometimes conventional banking is kind of changing because you have this peer-to-peer functionalities where depositors and lenders are meeting directly on platforms. So in a way, the different internet platforms you get serve the function of a bank, but they are not really taking the risks of the bank. They're just providing a platform to meet. Somebody said earlier that depositors and lenders are not, it's not practical for them to meet anymore, meet and lend and borrow. But if you look at the situation now, I'm just moving away from the lesson slightly to give you all an option to think a little bit. If you look at it now through the digital apps that you have and through the platforms created, we are creating these massive marketplaces now where these depositors and lenders can actually meet. But some of the risk element in terms of, if you give your money to somebody on a peer-to-peer platform of not getting your money back is still there, because you don't have a bank or an institution or clearing house or whatever you want to call it in the middle of it to manage that risk for you or to take on that risk for you. Your contract is directly with the lender or borrower. In conventional banking, you have that. So that function of the bank is to be that intermediate that everybody can rely on. And they charge an interest rate in between that to manage that risk. Now, the difference is if you take a deposit at 3%, you lend to a guy at 7%, you have arguably you have a 4% margin. 4% margin represents your margin on your lending rate, capital employed, liquidity, all that is within that 4% as well. But that is the conventional banking system that we operate in. And that is what a bank does as a primary function. Facilitate is lendings and borrowings to depositors and borrowers. So as we've discussed, investors, depositors would basically, you put their surplus funds into the bank, and borrowers will basically come to borrow from the bank the deficits that they have. So it's a financial intermediary. The bank is a financial intermediary. So in order to function, the bank can operate around how the deal flows. It gets a deposit and lends it, or it has a borrowing and then goes after deposit. So I'm sure all of you all from some point, or if you all have worked in a branch, you all would have been part of these various deposit mobilization activities the bank has, or on an aggressive lending platform and lending drive that the bank might have. So various things like that. I'm sure you would have all been part of something like that over the years to basically to drive something. Now, why do you think that is? If you are, say, a part of a bank and you are on a deposit drive, what's the reason for that? Why would a bank have an aggressive deposit drive?
The reason maybe the bank may have more funds to lend with them. Maybe
Deposit drive. I said deposit drive, not lending.
Yeah, they may have more deposits to lend.
Oh, you're saying that you're collecting the deposits in order to lend, is it?
Maintain liquidity?
Sorry?
To maintain liquidity?
To maintain liquidity, yes, okay. Yeah, so you're right. So it could be that the bank is shoring up its deposits in order to go on a lending drive. It could be that the bank has already lent money and it has identified that it has a gap in its balance sheet and it needs to sort of raise short-term or long-term liquidity for that purpose, for that funding purpose. It could be that interest rates are expected to pick up in the future, and they want to sort of lock in deposits before the interest rates pick up, so that they have lower interest liabilities on their books before the interest rates sort of pick up again. Could be various reasons, but at the end of the day, they could basically look at it from a point of view of, look, we need to do this now before anybody else does it. Or it could be that it is something that they are forced to do. So I can give you an example. Interest rates in Sri Lanka were around 20%, I would think, about 6 years ago, 5 years ago or so. And at that point, the banks were scrambling around, even at those interest rates, and trying to get people to deposit money. Now, there was a time you could get a 5-year deposit from a bank at something like 15%. And at that time, also people were reluctant to put 5-year deposits, thinking, oh my God, that's a long time. I don't want to put my money in for that long. But now a deposit is like 3% or 4%. So anybody who had invested at 5% with the bank at that time would be, basically in a good place right now because he's getting fined by 15% when the banks are currently only paying 3 or 4% for a deposit. Now, the question there is, why would a bank at that time with that kind of high interest rates want to still take 5-year deposits at 15%? Why would you think that was the case 4 or 5 years ago? Even at those high, because I mentioned to you that if the interest rates are attractive, then the banks go out aggressively and try to borrow money. So 15% wouldn't have been too much of an attractive rate to borrow money at for a bank. But why do you think they did it at that time? There's no wrong answer. You can guess. Yeah, so the reason for it is simple. Banks expected that situation at that time where interest rates were just skyrocketing to continue for a while more. But more importantly, they were worried about liquidity, because there is a reason interest rates were high. Interest rates were high because there was a lack of liquidity in the market. So every bank was trying to make sure that they show up their liquidity and they had funds in their books, and they were not sort of short of liquidity. So in order to manage that liquidity situation and to ensure that the ratios add up and the bank doesn't get caught of breaching, they were willing to sacrifice interest and lock in for even long-term deposits in order to make sure that the bank. So there was a bit of a risk management element more than a profit element there. And unfortunately, a lot of banks had to basically, when interest rates came down, subsequently had to tolerate these high yielding deposits on their books till they dropped off, basically. But that was the reason at that time. So basically, like I said, management of funds, maintain liquidity and profits. The interest rate exposure of the bank could be short-term and long-term. Foreign exchange could be transaction risk. I will touch on that a little bit. And then we have the banking relationship, working capital, cash management, working capital management, and all the other reporting and regulatory requirements that are there as well. Before we go into that, let me just touch on this a little bit. We'll be touching in depth later, either myself or Nishanta in our sessions. But when you say interest rate exposure management, you do it basically to manage the bank's interest rate exposure in terms of the assets and liabilities that are created from a short-term and long-term perspective. Meaning, if, for example, we feel interest rates are going up in the next 3 months, we need to make sure that we have enough assets on our book on that period to at a lower interest rate as possible, so that we manage the risk going up from interest rates picking up. Even on a long-term perspective, the same thing applies. Foreign exchange exposure, translation, and transaction. So basically, transaction is what you see on a day-to-day basis. Dollar-rupee rate picking up, going down. You have exporters, you have importers, you're a buy-export-import bank, you're a buy-export bank, whatever you want to call it. Every single transaction a bank does, there is an exposure to the bank in terms of risk. How do you manage that risk? What do you do? What's your strategy? Do you have a buyer for each seller? Do you have products that can sort of structurally reduce the risk that you are taking on a banking transaction? All that. Translation risk is more to do with the balance sheet, where at the end of a certain term, you have, say, foreign currency assets on your book or foreign currency liabilities on your book. And at the end of a period, the movement in exchange rate would basically have an impact on the value of that asset or liability that you have on your book, or the capital that you have on your book, which is coming in US dollars or whatever it might be. How do you manage that risk? So, for example, if I'm a multinational company that has profits to be repatriated at the end of the year, it's a transaction, but it's also at the end of the year, you might decide you're not repatriating, you're keeping. So it doesn't necessarily have to be a transaction. At the end of a financial year, I might have, say $10 million that I need to remit out of the country. Now, the dollar rate is at the moment, we'll say 200 rupees. You feel at the end of 2020, we'll use 2020 as an example. 2020, the rate was 185. Now today, the rate is going at about 200. There has been roughly about an 8% depreciation in the currency. Anybody who had bought capital into the country into 2020 and basically now wants to sort of take his profits out or repatriate something or whatever it might be, has a 8% depreciation in the value of his profitability, because ultimately he has to buy it. So that's translation risk, right? You might decide not to and keep it on your balance sheet throughout, or reinvest it locally or whatever you want to call it. But at the end of the day, you run a risk from the assets and liabilities you have and your balance sheet exposure that you have if it is denominated in foreign currency. And that's called translation risk. A lot of multinational companies who are located around the world run this risk. And you can manage this risk by entering into options and various products. But often the challenge is that there's no transaction. Since there's no transaction in, what value do you put to this? Is there a capital amount that you have that you isolate and put a value to this? And a lot of countries, regulated countries like Sri Lanka, we prevent translation risk hedging. Most of it is towards transaction risk hedging more than translation risk hedging, because it's a very opaque area. But in countries where there are no restrictions, it's freely allowed. You just need to figure out what the value of that hedging requirement is. So bank relationship, meaning Treasury actually manages the relationship with the bank. So you have in a bank different relationships. You have the corporate customers, you have your retail customers, you have the financial institutions, and you have the banking. So financial institutions and banks are more or less the NBFIs and the banks. These two institutions, there are separate relationship management teams, but often the touch points for a lot of the banking relationships is on the Treasury side, where you have interbank counterparties you deal in as for your day-to-day transactions that you do, and basically how you basically manage that those relationships. The Treasury guys are the usual guys who have a lot of interaction with the banks, while the corporate banking teams will have a lot of interaction with the commercial customers of the bank, and the retail banks will have a lot of interaction with the retail banking, personal financial services, or whatever you want to call it, will have more interaction with the retail or the individual customers of the bank. So cash and working capital management, like any other company, we need liquidity to function on a day-to-day basis. Treasury keeps the cash flow flowing, working capital requirements flowing, and also in terms of reporting and controls and results. So basically, reports are generated, provided to ALCO and to all management teams as to what the liquidity situation is, what the profitability is, etc., etc., etc. So how they do this is how Treasury manages these risks and manages these functions is by operating in different markets. So we have the money market, we have capital markets, we have foreign exchange market, we have derivatives market, we have a commodities market in developed countries. You have different kinds of market. So the money markets could be domestic and foreign. So for example, if you are a local bank dealing in dollars, you could lend and borrow dollars locally. You could lend and borrow dollars with a bank in another country through your FCBU unit. If you are a capital markets bank, capital market is usually beyond 3 years, and you want to say, do an interest rate swap with a client who is based in Singapore, and you have approval to do that. You can do that if you can't do it locally with a bank based in Singapore, or you could do it with a bank based in Sri Lanka. Same with the foreign exchange market and the derivatives market and the commodities market. So the markets that the bank operates in, again, like I said, this is Treasury they're talking about, but like I said, there's a global markets element of the bank. They have access to different markets. So if I give an example for Sri Lanka, Sri Lankan sovereign bonds trade offshore, not in Sri Lanka. When I say trade offshore, local companies can purchase those sovereign bonds, so it's restricted to an extent now. Local banks can trade in it. They can buy it, but they have to buy it in exchange in Singapore, Dubai, any other developed country, where they have to just go in there and say, look, I want to purchase this Sri Lanka sovereign bond. Now the asset that they're buying is a fixed income asset that is a Sri Lankan issuer, which is the central bank or government of Sri Lanka, rather. But they cannot access in Sri Lanka because we don't have an exchange for that, and we don't basically have a way for somebody to buy it in Sri Lanka locally. So they have to access the foreign market in order to get the security and buy and sell the security, and it will be quoted on exchange. It will be basically housed and scripted overseas as well. So the money market and capital markets are not border controlled. It can be wherever. Usually in Sri Lanka, not usually, in Sri Lanka, any rupee denominated asset that you deal in, so LKR, corporate debt, bonds, etc., are traded locally. Because LKR is not a hard currency, it's a restricted currency, it's only traded in the domestic market in Sri Lanka. Same with foreign exchange for dollar rupee, also traded only onshore in Sri Lanka. Even derivative markets, anything done in LKR is done locally. And like I said, we don't have commodities, so it's not relevant, but anything done in LKR would have been usually done in Sri Lanka because you can't trade the LKR offshore. Any questions?
So this is related to translation process.
Mostly transaction. Sorry, you're asking a question on translation. Okay, sorry.
Yeah, is that the concept related to due? What we do in normal operations?
Sorry, I didn't get you. Process two? I didn't get that.
Translation, same concept as due. I just want to know that we are doing translations as well. No, so is it the same thing as due? Normally, at the end of the month, we are doing due transactions, checking due.
Due. Sorry, I'm not familiar with that concept. It might be something else that is known as something. When you say due, what exactly do you do for that?
Then due to the, it's like due to the exchange variances, we have to pay other companies some losses, so profits, something like that. Then what we do is, what we do, yes, what we do is same you explains like translation. We are preparing accounts and all those things which we owe for other companies and what we have to receive, something like that.
Yeah, so what you're talking about, this is, sorry, I don't see your name, Bharat, right? Or is this?
No, I'm Tarang here.
Tarang, sorry. So Tarang, it's like this. What you're talking about is what we call a mark-to-market valuation. So at the end of each period, not only monthly, actually daily, there is a mark-to-market revaluation of the assets you hold on to see whether, with the variation in the rates, are your positions in the money or out of the money, right? And then also are your customer positions in the money or out of the money. Now, based on that mark-to-market valuation, you come back and say, okay, fine. I think this is good, this is good, this is good. Yeah. And then you'll figure out, so I'll give you an extreme example. Okay. Say, for example, dollar rupee rate is today 200 rupees. Suddenly it goes down to 100 rupees. Yeah.
Right.
So we have to what has happened there. Now, if you have sold dollars to your importers at 200 rupees, and now that contract today, which was valued 200, say to yesterday, now today is gone down to 100. So the importer is out of money. Yeah. Because 100 rupees, now he has to pay me 200 when the market rate is 100. So immediately that becomes in the money for the bank by 100 rupees. And that comes out of the money. So what the bank has a risk is that if the current customer comes back and tells you, look, sorry, I'm not going to pay your contract because he can go and buy it cheaper. Then the bank has the risk that, look, it has already gone and hedged itself and managed its risk out with the expectation that the client will give him 200 rupees and buy the dollars from him, right? So the bank now has to go out and basically try and sell the dollars that he has, that is keeping for the customer, but not at 200, only at 100. It's not as the bank is going to make as long as the transaction goes through, the bank makes profit. Bank will go ahead and there nothing happens to anybody. But if the client refuses, the bank has the risk of making a loss. Not that it's going to make a profit on the transaction or it's making its profit unduly. It's just that it's going to take a loss because it's going to have to sell something that is cheaper out there, cheaper in the market now. Now that is, we are trying to record the risk arising from the mark-to-market fluctuations in the exchange rate. So what you're saying, that mark-to-market is part of the transaction risk, because transaction risk is more to do with, it is, let me put it this way. It is the mark-to-market variation. Yes, it is.
All right.
It is. But it is not looked at from a day-to-day perspective. It is more looked at more from a long-term perspective. So what you're talking about, that mark-to-market risk, and looking at it, monthly or weekly, is more in lines with the. This is not, the transaction is not in relation to any particular transaction that's already done. It would be could be in relation to say, for example, capital, like I mentioned, that if you have employed capital in an organization, right, and now that's not a particular transaction, it's dollars that's coming in, and now over the years you'll be taking out a profit. Now you've not done a transaction for that, or as yet, but you know that in the future you might need to do a transaction for that, where you need to convert your rupees into dollars to take those out.
Right.
So for example, if you're, let me give you an example. If you're a bank, local foreign bank in Sri Lanka, right? Just as example, you're earning your profits in rupees and you're accumulating your profits in rupees, correct?
Right. Yeah.
At some point in time, you want to repatriate your retained profits.
Right.
Right. So if you had bought in capital when the exchange rate was, say, 150 rupees, and then you're earning rupees, and every time you earn it, you are end of the year, you made your profits, say, end of 2020, and now you want to take the money out at end of 2021. Yeah. Now your profits have been retained from 2020, but throughout 2021, you have held on to it, and you have run the risk because the exchange rate has been depreciated for you. Or it could have appreciated as well, but in this case, we say depreciate. So your retained profits have now reduced in dollar terms by at least, say, 8%.
Right.
Now that's there. You have not done any transaction for this. It's just that what you're holding on to, the value has depreciated, just like that, without you doing anything, basically. Same way, if the rupee has gone to 150 rupees, without doing any exchange, you will have a gain on that of 30% or 20% or whatever it might be at the other side.
Right.
So the translation, so if you want to hedge that risk, the translation risk, then you can also do products to say, okay, I want to hedge my risk at this rate, prevent my profitability going. So it will impact mostly non-domestic companies in that country, basically. All countries, companies, low domestic companies who have a foreign element where they have to pay out from a foreign exchange perspective, they have to pay out something. Or, for example, if you have taken a dollar loan from somebody and you have to repay that in rupees, or convert rupees into dollars to repay that loan over a period of time. Yeah, there is a transaction element in it, but the loan also is getting revalued in a higher rupee element with the rupee depreciating. The value of the loan increases, basically. Rupee liability increases. How do you hedge against the value of that rupee liability, dollar liability, sorry, increasing and having a counter hedge? So some banks, some companies, for example, who take dollar loans, try to raise dollar deposits to have a natural hedge for it. Right? So, for example, if you are a borrower in dollars, if you could also have deposits in dollars, then with the value of the dollar borrowing that you have taken, picking up, or getting going up in whatever way, if you have a deposit as well, that also will pick up, right? So automatically you have a hedge on both sides for that. That's one way of looking at doing it very simply. But everybody who borrows doesn't have the ability to lend, borrow deposits as well as borrow dollars, for example. So I had a client when I was at HSBC who did that. They had borrowings in US dollars and they had imports in US dollars, but they also managed to raise deposits as well. So they managed that impact of their exchange appreciation by having a natural hedge, and thereby sort of reducing the translation risk they had, because both sides of their balance sheet had dollars basically. Was that clear, or
Yes, sir.
not get it?
No, clear. Got an idea.
Right.
Thank you.
Okay, so going back to the slides, so the domestic market is, like it says, I mean, the domestic market is a market in which money or funds are borrowed and lent for a short period. Usually in Sri Lanka, it's below up to a year. In other markets, you can go up to as much as 3 years for money market products. And they trade in local currency. Like I said, there are some dollar transactions done between the local banks as well, but it's mainly all in LKR, and it's subject to regulations of the domestic market that you operate in. So again, foreign capital market is where you borrow or lend, mainly in Sri Lankan cases. A lot of the banks would borrow from other banks. They have relationships with other banks. And it could be for a short term as well, but capital markets are usually beyond that, beyond 3 years. But it's definitely capital or domestic or money market. If you are borrowing foreign exchange related, then you will do it overseas. So capital markets basically, I know. So just to say, we'll take a break at 10 o'clock. It's about 15 minutes from now. So I'll go on till then, and then we take a break, 15 minutes break, and then come back afterwards. Capital markets. So before we get to what is a capital market? What's the purpose of a capital market? And how can capital be borrowed and lent, and what are the primary ways of doing that? What is the capital market? What is capital?
Funds to run a business.
Very good. So then, if capital is funds to run a business, what is a capital market?
The place where we can borrow the funds.
Exactly, 100% correct. So there are primarily 2 ways that you can borrow capital. What are the 2 ways?
Primary market and secondary market.
No, that's the phases of a product. I'm asking, there are 2 ways in which you can borrow capital, or rather you can raise capital.
Share, debenture.
Right, so correct, 100% right. So in broad terms, what do you call share issuances and debenture issuances?
Equity and debt.
Exactly right, 100%. So there are only 2 ways people can raise capital. You can raise it via equity, you can raise it via debt, right? So the 2 instruments, the 2 broad categories, then stem out into the different instruments you use to raise that capital. So your stock market will be the equity market, and you have primary IPOs coming out, and basically you're issuing shares, and then it's traded on the secondary, all that. And then you have the bond market for the people who want to borrow, or debentures or bonds or whatever you want to call it. long term, like I said, this is so anything below 3 years, in Sri Lanka is below 1 year, is not considered capital. But in this case, you're talking long term bonds and debentures, etc., which form the debt part of the capital market. So why is it important for there to be a capital market? Why is it important for there to be a capital market?
In case of emergency of funds, without any difficulties, we can borrow funds from there. So there will be no pressure. So there will be no any difficulties. That's it.
Right. Very good. Good answer. Any other answers also?
Businesses can't run in the same capacity all of the year or all of the period of time. In time to come, businesses need to expand. In such situation, they might not in a position to expand by their own funds. In such a situation, organization need funding from third parties to expand their businesses. In such situations, capital market supports companies to expand their businesses through funding.
Good. Yes, very good. Anything else?
To cover long-term requirements.
Funding requirements, is it?
Yes, funding requirements. Yes.
Right. Okay. Anything else? Nothing is wrong. I'm just looking to listen to your answers. I'll weigh in at the end.
Borrow at a competitive rate of interest.
Yes, very good. Yes. So how does a company decide between debt and equity?
So depending on the existing capital structure, they'll decide which one is most profitable to them, and depending on their situation, whether it's they can spare some ownership or whether they would just want to get debt.
Yes. Okay. Good. Any other answers?
They borrow more funds from the equity market, the ownership will be transferred to the third party people. So if a institution borrow more equity funds, they will be more debtful to the financial situations. So they have to manage. So depending on the situation, they will borrow.
Okay, very good. Okay. Firstly, thank you very much for the answers. It's very good. It's very useful to have the interaction. I think it gives me a sense of your understanding, and they're all very good. So thank you very much for that. So yeah, so basically, it's a meeting place for borrowers and lenders, basically, in capital markets, because at the end of the day, like in banking, you need a marketplace for people to meet. And in some cases, there are physical marketplaces. In some cases, there are no physical marketplaces. So foreign exchange market, for example, there is no physical marketplace. It's a worldwide because there is no primary issuer. But in capital markets, there is a marketplace. So for example, if you look at the Colombo Stock Exchange, it is a marketplace, it's a physical place, and that's where all the shares trade and everything happens on that. Same with some of the listed debentures and so on. So in case of some capital markets, there are physical marketplaces, and other capital markets, there are not, right? Now, the purpose of the capital market is to provide a platform or a place where people can meet, and borrowers with requirements for funds and lenders with surplus funds can basically get together and say, okay, look guys, I have this money, I'm willing to lend it, what are the instruments I have? Right? And then you come out with this whole list of secondary market or primary market issuances that you go for. And it is easier than me being a lender and me being a borrower than basically you're trying to meet up with each other and say, okay, I've got money, would you like it, how much you're going to pay? So there are cases like that as well, there are cases where you have companies who will go directly to people who have surplus funds and says, look, I have a requirement. I know you have surplus money. It's a private issuance. We are not going to go through any debt house or anything like that. They will, do a private placement or something like that, if you call it, and they will basically transfer funds to them from a private placement perspective. So that's a different setup, but we are talking about the rest of the world as here. And then you have the requirement of diversification. So like somebody mentioned, you don't want to have, you might be a case where if you're borrowing from one person or 2 or 3 people, you might have to pay the person a higher interest rate because that guy's risk is limited to himself. Or say if you're a borrower of 100 million and you're borrowing from 2 people 50 million, and you default, those 2 guys are sitting and taking the majority of the risk. So they will demand a higher interest rate for that risk. But if you diversify to many people, you can obviously get a better rate of interest for your borrowing requirement, basically. So you have the beauty of diversification, and because everybody is sharing the risk amongst many people. That's one thing. The other thing is the form of debt, whether it's equity or capital. It comes down to a few factors, like you've already mentioned. One will be the cost. Is it cheaper to raise debt? Is it cheaper to raise the equity? So equity will have the price of the share you're issuing, the whole management of it, the publicity, the prospectus, and the whole work up and build up, marketing around it, all that. So it's a lot more work to get to the point where your equity is issued, and there could be a cost. There are cost elements involved, and then ultimately what price you sell it at as well, right? So all that put together, you do a valuation to see, okay, this is my eventual cost, and this is what I'm hoping to raise liquidity at, or raise funding at. And then you compare that to, say, going to a bank and saying, look, I want to borrow $1 billion rupees. What is the interest rate you can, lend me that at, right? That's one thing. Second thing about equity versus debt is the quantum that you're borrowing. So, like I said, $1 billion rupees. If it is 100 billion rupees or 10 billion rupees or something like that, right? There could not be one single institution willing to lend you that money because it's such a big amount and the bank can't absorb that risk by itself. So there might have to be a syndication, a clubbing of deals, or whatever you want to call it, in order to lend that to that particular borrower. Right, so the borrower will then say, okay, me doing that versus me going to the market and borrowing from issuing some of my shares. So it's the capital market, the choice of what you use is a function of the amount of capital that you would like to raise as well, right? And then basically the third thing about equity and debt is to see whether how much, like somebody already mentioned, how much of the ownership are you willing to divest for that? 5%, 10%, 15%, whatever it is, are you willing to? Because once you are issuing equity, it's not like just issuing debt or whatever. You are listed. You have certain protocols that you have to follow. Your shares trade daily. There are certain transparency and accounting standards that you have to maintain. So some people really don't want to go through that process, because it becomes a very publicly viewed company. Especially some of the family-owned companies would like to be a little more private and managed. So because then you're accountable to shareholders that are not necessarily your own people, and you have to basically be answerable to them, which is not a bad thing necessarily, but it is something that some people may not necessarily like to do. But any company going global, wanting to be larger, having themselves listed on the exchange and working on that base is always good because it creates a footprint for you. Now that is if you're a borrower. If you're a lender into the capital markets, what do you look at? You look at obviously the interest rate you're getting paid. You look at the value of the stock or you're buying and the return you're going to make of it based on the company that you're buying into, right? And then you look, why is this guy issuing a shares instead of borrowing from a bank? So, for example, if you have somebody who is issuing shares for IPO for Just an example, 30 million, 40 million rupees, right? Question I would have is, why isn't he borrowing this from a bank? He can easily raise 30, 40 million rupees from a bank, depending on the size of the company, of course. Going through a whole process of issuance to raise 30, 40 million rupees seems a lot of work, right? But if he's issuing for 2 billion, 3 billion rupees, like recently we had IPO for, I think, 2 billion rupees, that is in a way understandable, right? Because it's a large quantum. He achieves a lower rate or by issuing the shares at that particular price and raising that much of capital. So as a bond lender, although you're lending into an instrument issued by somebody, and you have to always ask a question of why this is happening, what's the rate you're getting. But it gives you an opportunity to select amongst various products to get that done. Any questions? Yeah, like I said, okay. See, okay, great. Did we stop? Yeah. Markets. Right. Okay. So like I said, capital market is a way of raising capital, and you have the debt market and the equity market in order to do so. The next market that we want to look at is the foreign exchange market. So basically, why are we looking at all these markets? Let's just double back a bit and just have a thought around that. Why are we looking at it? Because these are the markets that a typical treasury department or a global markets function will operate in. It will be serving customers who are in that market. It will be accessing that market for its own liquidity purposes or its own funding purposes or its own investment purposes, whatever you want to call it, right? And it will be dealing different products that are prevalent in this market. So it could be in the equity market, it could be in the bond market, it could be in the debentures, it could be in the foreign exchange market. So we are trying to understand the basis on which these markets operate. So you will understand in the treasury or global markets function, especially the front office function, it is very important to know what's happening in the world around you, right? It's a marketplace. You need to know what's happening. That's why if you speak to a person with a global markets or treasury background, they will need to understand what's happening with the economy. They will need to understand what's happening with regulations. They will need to understand what's happening with certain restrictions in terms of product usage and things like that. They will need to understand what's driving demand and supply for a certain asset class, right? What are their clients doing? What are their clients' exposures and how that impacts the market? So there is a lot of external factors that global markets people need to be aware of. And that is, I would say, more prevalent in global markets than in any other part of the bank. While at a strategic level, if you're sitting in ALCO or EXCO, you will have to understand the macroeconomy at a very senior level. If you're in a global markets function at the most junior level, you still need to understand those dynamics, because that impacts your day-to-day business, that impacts your day-to-day ability to do business and do things, basically. Yeah. So now we're talking about the foreign exchange market. Like I said, the foreign exchange market is not regulated, or rather, it doesn't have one particular regulator. And basically, there is no primary market for it. Everything trades on more or less one marketplace. Yeah. And where it's a place where you contract and you will have an agreement where you will say, I'm going to buy this currency versus this currency. Simple as that. Yeah. And it stays on a forward basis or a spot basis. Spot is 2 working days usually, and forward is anything beyond that period. It's the largest self-regulated market in the world. So financial markets again is basically forms a part of what the capital markets are. It is the money market, the currency market, all that fall within the financial market space. And basically, it all does the same thing. It provides short-term debt financing and investment opportunities. It gives you an opportunity to hedge your risk in terms of currencies, locally or internationally. And basically, it gives you an ability to transfer the risk that you have on your or that you might have to another person, and also gives that person to take the risk onto his book if he's comfortable with that risk. Derivative market forms part of the financial market. Can somebody tell me very in your way what a derivative is?
So it's a financial product.
Sorry, one at a time. Who is this first, Nipuna, or who is this? Go ahead, please. Whoever is spoke first, please go ahead. Okay, now nobody's talking. Somebody has talked, please.
So it's a financial product which is traded on with an underlying asset.
Okay, very good. And the second person who spoke?
It's a financial product which reduce risk and allow customers to purchase or sell in a investment purpose or a risk mitigating purpose.
Okay, right. Any other answers? Okay, so derivative is, if you look at the word derivative, it derives its value from a different asset class. So for example, you have derivatives in foreign exchange, you have derivatives in interest rates, you have derivatives for commodities. So there is an underlying asset class. So if you take foreign exchange is asset class, and the derivative derives the value of its derivative by looking at that asset class and saying, okay, if this happens to this asset class, this is what is going to happen with the derivative, right? In other words, what it's saying is, look, if I have a foreign exchange requirement to buy dollars against rupees in 1 year's time, and I want to cover that risk, again, if I don't want to wait till the spot rate and take the risk, the spot rate will be higher in a year's time, I can enter into a forward contract, which basically is saying, look, I'm going to lock in my interest rate exchange rate for 1 year. So technically a forward is a derivative, and then that's done. So the derivative, the value of the product, the forward contract being the derivative, comes from the underlying asset, which is the foreign exchange spot or foreign exchange rate. Or I could go into a dollar rupee option, where I have the option of buying or selling. That product works differently, but the value of it, what I would say, how much you have to pay for me for that optionality, or how much I have to pay as premium for the forward, all that value comes from the underlying asset. So technically the derivative derives its value from the asset, but it's a separate product. That's what you have to understand. So for example, if you had an importer, okay, who had to buy foreign exchange from, say, bank A, yeah, and then he has a forward contract that he enters into, right, with bank B, yeah. The forward contract with bank B is a separate contract. His underlying asset, which is the import transaction, is a separate forward contract is a separate contract, sorry, and the underlying transaction, which is the forward requirement to buy for its import purpose, is a separate contract. So how they will be matched is on the date of the transaction. If he has agreed to buy dollars at 200 rupees on the forward contract, the spot rate on that day is say 210 rupees. Instead of buying the dollars on the spot date from bank A at 210, he has a forward contract. He will buy it from the bank at 200 rupees and transfer those dollars to the from bank B to bank A, and his transaction is done separately. But bank A technically doesn't know that he's done a forward with bank B till he tells him that he has done it. So for all purposes, on the date of the transaction, he could go to bank A and say, look, guys, I want to settle my bill. What is your rate? That guy could quote him 210 rupees and he could do the spot transaction there. He won't because he already has a forward contract, which is cheaper for him. But he could always do that and the bank will fulfill it because the bank doesn't know that he's done a forward till he tells them that he has done a forward contract for it already. Yeah. So what I'm trying to make you understand is derivatives as of derived, the value is derived from an underlying asset or transaction, but it is a separate transaction by itself. Is that clear?
Yes.
Yeah. So commodities, same thing. So what these two slides are trying to show is the different types of financial markets that are there that you can deal in depending on the asset class that you are in. So we'll jump into fund management and start with the basics. What are the main variables that you have to look at when you're a fund manager of anything, bank or anything? Is A, what are the value of funds that you want to actually borrow or lend or whatever it is? How long do you want to do it for? What are the currencies you have this for? And what are the risks that come out because of the amount, because of the tenor, because of the currency, because of the access to liquidity, all those things, right? Why are you trying to do that? Because once you know what your risk parameters are, what your values are, then you can actually take decisions on how you want to move forward. So basically, if you look at the amount, so in fund management or any business that you have, you are looking to match your assets to your liabilities in the most prudent way possible, in the most optimum way possible. So for a bank, how does this work? If you're managing the balance sheet of a bank, how would you want to manage your assets and liabilities? What are the things that you will look at when you're looking at a bank's balance sheet and say, okay, look, I need to optimize, forget everything else, just simple assets and liabilities. How would you manage it? What are the things you'll look at for that?
There should be a balance between assets and liabilities. As in, if we have more assets, it means we have the cost of maintaining assets as same as if we are having more liabilities, there's a risk of lacking funds to cover such liabilities. So we need to have a balance in between assets and liabilities for a profitable management.
Okay. Any other answer also? Okay, so this current situation we are in, where are rupee interest rates at the moment?
It's lower.
Low. What is it? Give me a rate.
It's 3%.
For deposits. For loans?
It's starting from 6.5 upward up to 11 point.
Okay. So in this environment, what are banks looking to do?
Both banks getting more deposits as well as lending.
Okay, but do you think people are really interested in depositing it at 3%?
No, actually, in the depositors' perspective, it's not good for depositors, but for the bank perspective, cost of funds are low, so bank's perspective is to get more deposits.
Very good, but do you think the banks are really getting a lot of deposits at these rates?
No.
Okay, so where are those monies going to? Where could the monies be going to?
Most probably, people will go for treasury bills or something like that.
Treasury bills are how much is the rate for treasury bills?
It's about 5 to 6%.
Yeah, about 4 to 5%. I will 4% to 5%. Yeah, okay. All right, okay. So you are there. So even then, is that very attractive?
No,
you think?
actually no, because earlier FD rates were around 12 to 13% sometimes back. So it's the perspective of depositors, it's a loss for them, but in the bank's perspective, for banks and financial institutes, it's a profit-making situation.
So right now, if you look at the banks, typical, forget about the economic situation for a second, just take things are all good and all that, leave aside the challenges we have. But if you look at all that, right now, from a balance sheet perspective, which side of the bank's balance sheet will the bank be concentrating on growing more?
Deposits.
Yes, but in reality, what can it really grow?
Assets.
Because which is liability, which is basically the asset side, which is lending. Because now at the moment with the interest rates being this cheap, a lot of people, like I said, leave aside the economic side of it for a second. I'm just talking from a pure looking at the balance sheet and thinking everything is good and people are looking to do business, that kind of mentality, right? Ideally, what's going to happen is people are going to want to borrow money as cheap as possible to do their business, correct?
Exactly.
So bank will basically be able to lend now easier than they did when the interest rates are 14%, correct?
Yes.
Yeah. So now technically you can borrow at 6%, 7%, which is half what you could have borrowed 1 year, 1.5 years ago. Yeah. So in other words, you can basically, a person who could have borrowed 10 million rupees, arguably with the same income can borrow now 20 million rupees.
Yes.
Yeah. So that's possible, right? So basically the asset side of the equation will now pick up. So from a balance sheet perspective, if the bank is marketing it well and promoting it well and doing everything, your assets are going to balloon up, not necessarily your liabilities.
Yes.
Right. So you are sitting there, your assets are growing, and you, like you very rightly said, you need to go out there and try and win deposits, right, from your depositors. Now, you might not be able to do that necessarily because depositors may think, look, I'm not going to come and put in the bank for at 3%, 4%. I'm going to put it on shares. I'm going to buy a house. I'm going to use it to buy a car. Might as well do that. Then alternative investments instead of really looking at the conventional stuff. Correct, right? So how does the bank then now there's a challenge, right? You will find at some point that your assets have amount of assets. We're talking about amount here, right? Amount of assets has suddenly ballooned, and your liabilities are short. Now, how does the bank then balance this off? That's what we are coming to now.
Raising funds from as debenture issue or share issue.
That's right. So when to raise debentures and shares, what do you have to do to attract those funds? Forget shares for a second, just say debentures. How would you raise funds there? You basically then go out and basically increase the tenor, which is the second part of it, right? Instead of trying to borrow 3 months deposits and 6 months deposits at 4%, you come out and say, okay, I'll give you a 5-year deposit at 5-year debenture at 10%. And you have to make it attractive for the investor. Say, okay, guy who doesn't want to put 3 or 4%, but if he's getting a 10% return over 5 years, he might say, okay, I can live with that. But the bank then is taking a view that, look, for the next 5 years, sorry, I'm going to be having to pay a 10% interest rate. And still that doesn't matter to me because I'm sure, because look at what the bank is doing, right? If we are raising the money at say 8 or 9% on a debenture for 5 years or 10%, and it's lending at 7%, what is effectively what is happening here? Effectively what is happening, you are borrowing long term at a higher rate than what you're lending at. Yeah. And what you're saying is that interest rates will probably pick up, or on average, I can still beat that 10% rate. Or you're saying, look, the liquidity is more important to me because I'm growing my asset book so fast. I need to pay up the curve for me to be able to fund that. Or else, what the bank will have to keep constantly doing is going to the central bank reverse repo window or something like that, pledging his treasury bills and balancing the liability side, asset side of the book by raising liquidity or liabilities from that side of the book by funding it short term all the time. So what I'm trying to say is there's no one answer, there's no right answer. It all depends on the situation that particular institution is in and how they want to manage it, their view on interest rates, so many things, right? But basically, if you are growing assets, you need to make sure that you have a counterbalance on the other side, on the liability. Same way, if you're growing liabilities, you need to make sure that you have a counterbalance on this side for your assets as well.
So in such a situation, we can get funds from foreign banks like borrowings and relend it to locals, right? Some
You're talking
instances
about dollar funding.
Dollar funding, yeah, like ADB, such institute from such institutions.
So when you say we, who are you referring to?
We in Sri Lankan local banks, getting funds from foreign banks in dollar loans and lending it to Sri Lankan communities and business personnel.
This is who am I speaking to?
I'm Nipuna here.
Nipuna, you're working for, you said?
Commercial bank, Treasury Processing Department.
Right, okay. So now, if you look at where the local banks need to pay for their deposits at the moment, what are they paying for them? NRFC deposits or PFS deposits.
Sorry, sir, again.
What is the interest rate banks pay for deposits right now for deposit holders, dollar deposit holders, or any other foreign currency?
It's around 1.75 to 2%.
For deposit, fixed deposits?
4%.
4%, 5%, could be even as much as 6% with some other banks, right? Now, what is the actual dollar interest rate in the US? What is LIBOR? What is the US interest rates right now?
LIBOR stands at 0.11.
0.11. So what are the local banks paying for deposits now? We'll say 4%, 5%. Yeah. Why is there a difference?
Use the exchange rate.
Not the exchange rate. No, it's because of this same thing that Nipuna spoke about, right? So you're right, Nipuna. If you need foreign exchange or foreign currency deposits, you can go offshore and borrow. There are two elements to that. What rate do you borrow at? And second one is, are people willing to lend to you, right? Now, for example, what rate, how does it impact you? So all these foreign currency deposits that you take, what are you doing with those deposits? You have to re-lend those. No? You are just not going to hold on to those deposits. You have to either swap them into rupees, generating rupee for your day-to-day activities, or you have to lend it to people who want to borrow from you. So if you have to borrow deposits at 10%, can you lend it to somebody at 12%? Dollars I'm talking about. Doesn't make sense, right? So you have to be able to borrow these deposits at a rate that is feasible for you to on-lend it at. Or if you're a bank that has already invested in high-yielding dollar assets, like for example, if you had bought a sovereign bond, that was when it was trading at 20% or 25%, then you raising deposits at even 10%, dollar deposit 10% is economically makes sense for you to do it, right? But remember, when you borrow from offshore, it's not only the rate that people are looking at. They're looking at the risk. Meaning, look, if I lend to this guy who is based in Sri Lanka, what is the risk of me not getting my money back? And how do they perceive the risk? How do they monitor the risk? What are the elements they look at for that? If you're borrowing from an offshore counterparty and he has limits for you, what would he look at?
The
Credit
rating of the
rating.
institution.
Credit risk, yes. Other question answer, I didn't hear that second one.
I said the rating.
Rating, yes. Rating is a reflection of your credit risk and your overall risk, yes. What else?
The economical condition of the country.
That's 100% right. So there are several elements. He will look at the bank itself, what the rating is, what the standing is, and of course the relationship that you've had with them for over the years, how you have performed. Second thing of it will be, and overall context, look, even if the bank has the ability or the need or the intention of paying me back my money, will the current economic conditions allow him to do that? Will there be restrictions in the economy? Will there be a dollar liquidity shortage where he can't re-borrow those dollars and give it to me? Will his depositors pay his money back to him for him to pay me the money? Something like that. So there are various factors. So unfortunately, in developed countries, it's not an issue. You can borrow from anywhere, anytime, anywhere, no problem. The cheapest source of funding, you go out there and you borrow. But in emerging markets, developing markets, especially when there's strain on the economy, accessing those funds is not always easy. And that comes out in the interest rate you pay, and comes out in your ability to, get people to lend to you as well. So it's a challenging time in that sense as well. So those are things you are doing, because what happens is when your rating drops and when your overall economic condition drop, access to these funds are not always that easy. Especially in your non-domestic currency. So if you are looking at dollars or anything else, that challenge is more prevalent because of that.
Okay, thank you.
So one of the other things is the tenor. So basically, I mentioned that, look, if you are lending, if you have borrowed and then you are creating assets by lending, then suddenly your depositors come back and say, look, I want my money back. You borrowed 3 months, 6 months, 1 year, and then you have to repay these funds, right? Part of the Treasury's function is to make sure there's enough of cash flow to pay these depositors back. This is more the case with short-term funding requirements, because if you manage to lock in a depositor for 4 or 5 years, then you're fairly safe. But obviously for that, like I mentioned earlier, you might have to pay up the curve and pay a higher interest rate. So you might not necessarily want to do that. So traditionally, what people would like to do is to have long-term deposits and short-term lending when interest rates are basically on the lower end of things. So we basically try to borrow long-term at the lowest possible rate and lend short-term at the highest possible rate when interest rates are low. When interest rates are high, you will want to borrow short-term at the lowest possible rate again, and lend long-term at the highest possible rate, basically. So because of the way you manage your cash flows and funding, based on your view on interest rates, there will be different situations where you need to raise liquidity to pay off your depositors. Also there could be a situation where a significant asset or lending in your book drops off and you have to replace it with a lower interest earning asset. So all these means cash flows have to be managed, right? And that has to be coordinated, and that coordination happens within a Treasury department with ALCO, all these people, but it happens within the Treasury department. Like I mentioned, the gap in the money market happens between the maturities of placements of loans and the maturities of borrowings and deposits, because there is never a perfect balance sheet where your deposits mature lending and your lending matches your deposits. There is never a case like that. There will always be mismatches. You just need to match those, what we call gaps in those deposits, right? And lendings. Through that gap management, you achieve a profitability scenario, as well as make sure that your bank is protected. In the foreign exchange market, a gap is the difference between the maturity of your buys and sells. it is not that much of an issue. It also feeds back into your day-to-day cash flows, because ultimately when you do foreign exchange contracts forwards, you are taking away the foreign exchange risk on day one. After that, it's just a matter of managing the cash flows, which also comes as part of your day-to-day cash flow management exercise. So for example, if you have forward contracts maturing where the client is buying dollars from you and giving you rupees on day in 3 months time, on that particular day in 3 months, you are expecting X amount of rupees to come into you, and you need to make sure your nostro has X amount of dollars to pay for that dollar commitment. So you plug in those cash flows on that particular day. Now what happens? Suddenly the guy who's supposed to buy the foreign exchange says, look guy, I can't pay you on that day, give me one more day to pay that. So what's going to happen? You have excess dollars in your nostro, which you then need to then lend for a day overnight, and then you don't have rupees in your rupee account. In your dollar central bank, your customer is not paid you, so you have a, if you have been expecting that money as part of your cash flow management, then you need to go outside and say, oh, okay, I want to borrow overnight for some money. Yeah, so that part of it is then managed by, you need to make sure you have that. So that's why active cash flow management is very important. That's why good MI is very important. That's why good systems are very important, so that you have a fairly good idea where you can forecast when your cash flow requirements are taking place. And if it doesn't, you have sufficient time and tools to go out and plug in any gaps that you have. Yeah, so basically, net exchange position, I'm not going to go in too much here, but basically what he's talking about is if you have buys and sells in one currency and you have assets and liabilities in that currency, what is your net exposure in that? The net open position basically reflects whether you're long plus a currency or minus a currency. And basically based on that, what you can and can't do in that currency pair. For example, Sri Lankan banks are given a net open position in US dollars. And the central bank might say, look, your net open position is $1 million. And at the end of the day, you should be able to monitor, say, okay, I'm within my position or I'm not within my position for that period. You know, that kind of exposure is important, because then you can monitor to see if whether you are excess dollars against rupees or minus dollars against rupees, and more importantly, in Sri Lanka's context, to make sure that you are within the limits, because the regulator has stipulated limits on this, right? So it's not as if it is a limit that you monitor only for yourself for own risk management purposes, but it's a management of a regulatory limit that has been imposed as well. So the key variables in risk management. So we know about risk management, and in this case, we are looking at 3 types of risk: liquidity risk, credit risk, and market risk. Okay, so stop for a minute and ask a question here. What is liquidity risk? First, we take that. When you say liquidity risk, what is that? What does that mean? What is liquidity? In your words.
Ability to pay debts.
Okay, ability to pay debts. Okay.
If sudden demand arises, we can have some sort of money.
Okay, good. Anything else?
Not having sufficient liquid funds at hand to settle an obligation.
Okay, so, okay, fine. If I make a statement saying, I hold a debenture, but it's not liquid, what do I mean?
It cannot be converted to cash at a reasonable time, at a reasonable
within short time.
short time.
Yeah, very good answers.
Cost.
Definitely right. Yeah, so what it means is that, look, I bought a debenture that is issued by X company. It's paying me these interest rates and all that, right? but it's not necessarily something that, like you said, can be sold immediately. Yeah. So, for example, if I were to take the Rupee bond, LKR bond market, the bond market gone up to 15 years, 20 years, but it's active probably up to maybe 5 to 7 years, right? The bond market, there are liquid bonds and there are bonds that are not very liquid. Meaning that we can say, I'm just saying, there could be a 3-year bond that is issued that is very liquid. Everybody buys and sells it, buys. For some reason, it could be that the tenor is good or that particular maturity, there's something that people are attracted to, I don't know. But there could be a 7-year bond that hardly anybody trades. So if I buy a 7-year bond, Rupee, Sri Lanka Rupee government bond, basically, and it's a 7-year bond, it's a government bond, so the risk is fine, credit risk is fine, or the issuer risk is fine. But suddenly I decide, okay, no, I need some money. All my other options are weighed out. I have only other option I have is to liquidate this bond, and it's not liquid. So what do I run here? I run a liquidity risk, right? That I have not kept enough funds through alternative methods, and I have to basically go and liquidate this asset, which is not a liquid asset. Basically, it's a liquid asset, but it's not as liquid in terms of tradability, right? So some people actually, the longer the tenor, the less liquid. When I say less liquid, how do I determine if the asset is liquid or not? How would I determine whether the asset is liquid or not? How do I back test it? How do I find that out?
So how easily you can convert?
Yeah. So how do I figure that out? If you are sitting there and you're trying to figure out
without demand for that,
without any loss.
Yeah. So sorry, somebody said demand for that. How do you figure out the demand for that?
Demand has in
Trade volume, how much that is traded.
That's right. How do you figure out how much that is traded? So you look at the past trades when it was issued. How many transactions have been done in that bond in the last few months, years, whatever it has been in circulation? You get a quote for it. You often, the liquidity of an asset is you can determine by the price that is quoted for it. So for example, if somebody is quoting you on a bond 710, 715, yeah, that means it's quite aggressive, meaning he's willing to buy at the bond at 10, sell it to you at 15. Yeah. If he's quoting you 7 and 8%, 7% and 8%, what does it mean? Or 6.5% and 8%. It means he's willing to buy at 6. It's a very wide bit of a spread, right? So you can also determine how liquid a bond is or liquid an asset is by the spread that the quote will be given to you by the market maker or whoever it is who's trading that bond. You can determine that it's a liquid or liquid bond at that point in time as well, or asset, bond, any asset. The bid offer spread reflects the liquidity situation, and the uncertainty around it is there. The more liquid it is, the narrower the bid offer spread will be from the market participant, because they also know that if they need to get rid of it, there is a market for it. So they don't mind quoting a more aggressive price for it. Is that clear?
Yes.
So liquidity risk comes from you holding on to assets that you cannot liquidate in a hurry to meet any financial obligations that you have. Yeah. Like I said earlier, if the maturity of the asset is longer or longer than the liability, so when you sell more currency, then the market will allow you to buy back, or whatever your situation might be, you find yourself, especially in terms of stressed out scenarios, where you don't have enough liquidity. Now, at the moment, for example, Sri Lanka will probably have a liquidity risk in terms of US dollars, where like we spoke of just a few while back, where we have maybe a difficulty in terms of raising dollar liquidity easily. So that is a challenge that you have. Right? So that that is something that the individual banks, central bank, customers, everybody has to understand and work with it and manage, basically. So we need to find sources of dollar funding, even at a premium. That's why the banks are paying higher interest rates. Some banks are paying even more higher interest rates for dollars than other banks, right? The ones that are fairly liquid and fairly comfortable pay a lesser interest rate. It often reflects in the rate you're getting, the price you're paying for it. That is a good barometer to figure out whether that particular institution is liquid or not liquid. So, for example, if you look back, 12 years in Sri Lanka now, looking back, if you look at the Silinco and the whole what was that, Golden Key Insure, right? They were paying, I think, 32% or something, right, for deposits at one time. When bank deposit rates were also high, not that it wasn't. I think those days bank deposits were like 15%, 20%, but they were paying as much as 30%. So somebody looking at that should have asked the question, look, does this bank have a liquidity issue where you can't raise funds from anywhere? So there's a credit issue also, but do they have liquidity concerns that they are paying up the curve or paying a very high interest rate to raise liquidity? Why is it? Have they overlent to people? Those questions should have been asked by people who want to deposit money there at that time. Because if you're paying a high interest rate, it reflects that you could be having a liquidity issue and you want to raise deposits at whatever price in order to meet your liability requirement, assets basically, your asset requirements, or lending requirements, or your balance sheet requirements basically. Yeah, which goes on to credit risk. So like I said earlier, the rate usually reflects liquidity and also the credit risk. So for example, if somebody is paying a high interest rate for something, and the question is, why can't you raise this money cheaper? Should come to your head. So for example, if you take the current AWPLR, which is about 5.5%, I think. Treasury bill rates, which are around 5%, 4.5%, 5%, whatever. Sri Lankan interest rates are hovering around the 5 to 6% rate. If you are a borrower, you should be able to borrow at 7%, 8% based on your relationship with the bank and your credit profile. So when I say credit profile, this is where the credit risk comes in. So the bank will usually lend to an institution or a company or whatever at the benchmark rate plus a credit margin. Yeah. So the credit margin is determined on the customer's rating, the amount you're borrowing, overall relationship, all the other businesses the bank gets, etc., etc., etc. And it comes, okay, this is the rate that we want to lend to you at. And then there'll be competition, and then there'll be a negotiation, and you'll end up. So most companies should be able to borrow at around, I would say 7, 8% now, even cheaper maybe. Yeah. So credit risk is that basically if you are a lender, that somebody will not repay your money back to you, right? Principal or interest. In the case of foreign exchange, it's the fact that they will not settle their portion of the foreign exchange contract that they have basically agreed to settle on that day. Yeah. So credit risk has several elements. So one is the obvious credit risk of where you will not get your whole amount of money back to you. That's what you call a settlement risk, basically settlement in terms of foreign currency, settlement in terms of a claim loan. There's also a credit risk where it comes to mark-to-market. So where basically you have entered into a transaction, foreign exchange transaction. You don't exchange cash flows in a forward contract till the maturity date of that contract. So you don't actually have a settlement risk, but you run what we call a mark-to-market risk, the same thing we spoke about earlier. Where on the maturity date of that transaction, you say, okay, I don't want to settle your forward contract. And then you are stuck with, say, US dollars, which you have to go and sell in the market cheaper than where the rate you contract to sell is there. And then you run the risk that the market differ because of the difference in the exchange rate. You have a loss on your credit loss on your book, which is the actual loss that you take. So it's not a settlement risk necessarily. It is a credit, because of them not settling you, it's a risk that you have based on the market movement. It's a mark-to-market risk. So that is also falls within the credit risk purview, right? So you then have to then figure out, okay, how do I manage this risk? So when you're doing fund management or when you're managing funds, you lend money to the person with the best credit and the best return. So when I say best return, how do I determine the return I get based on credit? How would I determine the best possible return I can get based on the credit of a client? Is my question. How would I determine the best return I get on an investment or lending to somebody based on the credit of the client, based on credit risk, from a credit risk perspective? Okay, let me put it this way. Higher the risk should be what? Return I should get is more or less?
Higher the risk, higher the returns.
Higher the risk. Lower the risk?
Low return.
Lower return. So if I were to then lend to central bank by buying a treasury bill, or lend to a CCC rated company at 12% or 15%, right? Which is better for me?
Central bank.
But I'm only getting
Depending
6%
on
for
the-
that. 5% for that, sorry.
If
And
you
the
are
other guy is giving me
that's a more
15%.
risk, then you can go for the higher return.
Okay. You say go for the higher one because they're giving 15%. Okay. Anybody else? Okay. So what happens there is, one is diversification. You have to make sure that you have enough of liquid assets and you have quality of asset is very good. So there could be restrictions on where you can invest this money, number one. Second thing is that you need to make sure that your risk return is calculated based on the return based on the capital employed and the return based on the rating of the company. So for example, Treasury bills could give you, say, a return of 1%, absolute return of 1%, but that 1%, when you look at against what it is against risk-weighted assets of the book of the company, a very limited amount of assets are held for the capital is held for the assets you're purchasing. While a lower rated investment like a CCC will absorb so much of your capital that will be kept aside because of the quality of the risk that you're taking. So your return in terms of risk would be higher, requirement will be higher. Maybe 10% more is not enough. Maybe you have to charge 20%, I'm just saying, right? For that particular investment, as opposed to putting it into a gilt-edged or government security or something like that, which will give you a higher quality of credit that you're absorbing. That's why if you have a corporate, you can lend to at AWPLR plus 1 or 2%, and you can lend to the government or the central bank securities at 5.5%. The 5.5% could be still better from a return perspective than that corporate debt you're lending to.
Because
could be
you
a
have
better.
to set aside more money to cover that risk, is it?
Sorry?
Is there a requirement to set aside some money to cover the risk of that?
No, what happens is you're calculating the return based on your capital that you're employing for it and setting aside for it. So if you look at your risk-weighted assets that you set aside for this, the amount of risk-weighted assets that you set aside for an investment in government securities is less than what you would set aside for a corporate who will arguably be rated lower. So it's return based on risk rather than return based on absolute terms.
Okay. Yeah.
Yeah, so it's not 2%. as opposed to 1%, 2% definitely more. But from a capital and return perspective, one of the matrices banks look at is how much of a return are you making on your capital employed. Not necessarily from an absolute perspective, what is the return you're making. Because you are looking to make sure you're using your shareholders' capital as optimally as possible in the best form. So you lower risk assets, but with a higher return is the best option you can get. So for example, have you ever thought of why people buy US government treasuries when it was almost 0%? One is they use it as a way of hedging against the US dollar and you buy a dollar asset. Other one is that, look, even at 0.01% or 0.1%, this is a better quality of assets, a AAA asset on your book, as opposed to a BBB asset paying you 5%. Because it has a better, the amount of liquid asset or the amount of risk-weighted assets you have to set aside for it is less than what it would be, much less than what it would be. So you can use those the remaining risk-weighted assets that you have, or ability to lend to other forms of investments. You're freeing up your capital to do that, basically, as well. Yeah, so it's a bit complicated, but what I'm trying to get here is just to simply say, look, when you look at credit risk, you're looking at the borrower paying you back. Yeah, so you determine that when you're lending by obviously the quality of the credit that you want to give, not only by the interest rate that you're getting. So you have to look at credit risk from the perspective of, look, I'm getting a higher interest rate, but does it mean that this guy won't pay me back? So I need to make sure that I balance off the risk, credit risk, with the return that I'm getting for that. Yeah. And then market risk, like I said, chance that, look, if the market interest rates work against me, how does that impact my assets and liabilities, and how do I make sure I manage that risk? So coming back to this, Treasury manages the bank's liquidity, capping a position, net exchange position, exposure to risk by coordinating each of the risk amount. So we've discussed this more or less. So liquidity, we know, we discussed it. Capping positions means what I mentioned earlier, where you may be having short-term liabilities and long-term assets all the way around. How do you manage those gaps? Net exchange positions is where you match your, say, dollar assets against your dollar liabilities and make sure that, whether you're long dollars or short dollars or whatever it is. And exposure to risk, meaning, if you're exposed to interest rates going up or down or whatever it might be, how are you managing those things? So by how do you do that? By determining the amounts you need to borrow, lend in each currency, by depending the tenors that you are going to borrow and lend in, the currencies that you might switch. So for example, if you have predominantly dollar, you might decide, oh, yen is good for me now, dollar is too risky, I don't have liquidity in dollars, I want to swap all my dollar assets into yen assets. Yeah, and basically looking at the overall risk based on that, basically. Yeah, so it just a little box there, taking each aspect and showing you what it is, in terms of liquidity, in terms of gapping, all those things basically. So liquidity, what is liquidity? We touched on. Okay, before that, any other questions, please? Okay, so we touched on this already. Liquidity is the ability to meet all financial obligations of the bank without a delay. It is also a measure of the bank's ability to fund any asset it wants to acquire. So already touched this. So what we're saying is, look, liquidity is the ability of the bank to fund themselves on a day-to-day basis or to meet any sudden requirements they might have. Yeah, if you have to sort of buy you decide Treasury gets up one morning, they said, I want to buy Treasury bills today. I don't have liquidity. How do I raise liquidity? You know, and then figure out the ability they have to do that, basically. So bank cannot survive without liquidity. Why? Pretty obvious. A bank needs money to cover all its obligations on hand. Failure to make a payment to a depositor will lose confidence or bank run. So just step back. Why liquidity is important? We've decided, we've looked at it from a monetary point of view. We've looked at it as to why it's important to have money to pay off your depositors, all that. But bank, if you look at the first slide or one of the first slides we did, it was, why do depositors give money to the bank? One is the interest rate. Other reason is why. What's the other reason people come and give money to you, put as a deposit?
Trust.
Sorry?
The trust.
Exactly. Banking is a industry based on trust. And when that trust is broken, everything goes, you know, you can be paying the highest interest rate, you can have the best people, you can have the best branches with the nicest looking, you know, little lobbies and everything. But if you don't have trust in the organization, everything falls apart. And we've seen that even in Sri Lanka, we've seen that around the world, where as soon as the trust in the institution goes, basically there's a run on the bank where people come and ask for their money back. Shares get dumped off those banks in the stock market. People don't want to even touch them, right? So not only in Sri Lanka, around the world, it happened during the financial crisis time. If you remember in 2008, 2009, with Lehman Brothers and all the other banks involved. So there was a big, so banking is about trust. So people come and give you their money saying, okay, look, I know this guy is going to give my money back. There's no question about that. So liquidity is a form of ensuring that that trust is maintained, that when somebody comes and asks for the money back, that you are in a position to give it back to you. Yeah, there, as we say here, believe in the bank to repay, bank says credibility. Bank's credibility is a huge thing. Yeah. Maintain liquidity permanent basis is a question of survival for the bank. Yeah, so do you all agree with this statement? Although the bank can afford to make a bad deal once in a while, it can never afford to be illiquid. What does it mean, and do you all agree with it?
So bank can make losses, but it can always have the ability to pay out its obligations.
Yeah, so is that, okay, so you agree with what the statement is?
Yes.
Yeah, why is that? So why is it okay to lose money but not be able to pay your deposit back?
Because if people get to know that you are illiquid, you lose your business, and
Yeah.
you lose money, you can make it after some time, right? You can still make money from other deals, but
So you're a depositor in a bank. You see the bank is making continuous losses, right? But you still keep your deposit. So you are looking at the balance sheet, the P&L of the bank, and you see that this guy has had a bad year last year, bad year this year. You're not a shareholder, you're a depositor, right? Would you be concerned? You have looked at a bank.
not
No.
that much, right? Because you
Not
know
that.
that you can get your money back.
Okay, you're a shareholder of the bank. Would you be concerned?
Yeah, obviously.
Yeah, you would know, because ultimately your dividend is not going to come to you, or share price might not go up or whatever, right? So ultimately, as a shareholder, you become, and a depositor might not. Okay, fine. You will look to see what would you look at from the bank to make sure that you are safe. What would you look at it? You will look at their liquid asset ratios. You will look at their capital adequacy ratios to see whether in their financials, they are maintaining sufficient liquid assets, that their ratios are within, or capital adequacy ratios are also sufficient. You understand what I'm saying? You will look at it more from are they liquid enough that if I go to the bank and ask for money, that they can give it to me? Do they have sufficient capital? That's why there are those ratios put in, so that as a depositor, you can figure out how close to their tier 1, tier 2 capital ratios there are, and to their day-to-day liquidity ratios, how close they are to those. But you wouldn't necessarily worry. You will definitely worry if the bank is continuing making losses. But I'm just saying, you wouldn't necessarily be looking at that aspect of it, unless they suddenly start to pay you very high interest rates, and then you realize, oh my God, he's making losses and he's now paying me high interest rates. Then I would be a bit suspicious, and I would look at it a little more closely, whether it's a short-term thing or long-term thing. You all agree with that?
Yeah.
Yeah. Right. So that is the importance of liquidity, right? Liquidity reflects on the confidence you can give to your depositors with it, that you will be able to pay back the money that you borrow. It is, if the bank is illiquid, can't pay depositors, and you can't fund these borrowings. Eventually affect your other banks and collapse the finance. So basically, it's a bit extreme, but if you are a systemically important bank in the financial sector of that country, if one bank becomes illiquid, you need to figure out whether that's an isolated incident because of that bank or institution, or it is something that is because of the market situation that the country, and then there are more than one bank affected. So for example, if you look at 2008-9 in the US, the financial crisis, the impact from Lehman Brothers impacted not just Lehman Brothers, but the whole financial sector, where there were bailouts given to the bigger banks as well by the US to support their, to make sure that there was liquidity and that the financial system didn't collapse. So you are talking about some of the biggest banks in Wall Street getting financial aid from the Federal Reserve in order to make sure the financial system didn't. And if you look back and read on the financial crisis, you will see Lehman Brothers, the Fed refused to support them. And that's one of the reasons they collapsed. So there's always argument to say maybe they should have supported them, and then they could have sort of prevented the entire contagion to the entire financial system and what happened after that. But there's also argument to say, why should you? Because you're using taxpayers' money to support these banks. But ultimately, they did support these banks, and they came out of it well. Sri Lanka, again, like I said, in 2008-9, the same time, we had this whole incident around Golden Key, and some of the banks there were impacted at that time. Again, the central bank supported it at the right time, and certain institutions were supported, and it came out of it, because ultimately the regulator has put in certain thresholds, but there could always be market situations that happen very fast, that even the regulator cannot act immediately. It is only after the fact or post the event that they can step in to sort of support that institution if required. And the requirement to support will be even more important if the institution is a large institution that is systemically important to the economy that particular institution operates in. Yeah, I think we are almost. Yeah, so we will finish off with the role of central bank today. Any questions up to there? I have one more session to do. One more section to do on central bank before I move into that. Any questions up to there? So, okay. So basically, what's the role of central bank? So but anybody from central bank here on the course? Okay. Can somebody tell me, this is basic economics, if you have done a degree or some sort, you would have covered this already. What does the central bank, what are the main functions of a central bank?
Maintaining the stability of the financial system. And
very good, yes.
Governing the financial.
Sorry, go ahead.
Price stability and financial system stability.
Very good. Somebody else said something as well.
Governing the financial institutions in the country.
Okay, right. So central bank has a broad role: price stability, financial system stability, and in order to do that, they have to basically make sure that there's liquidity in the market. There's, they control money supply, and basically those are the tools they will use to manage price stability and financial system stability. So we've discussed liquidity, and that if there is a liquidity issue in the market, how a central bank has to step in through their various tools, whether it's open market operations or whatever it is, to actually provide the liquidity required in the market. They also manage price stability. Part of that is by managing money supply in the market as well, right? So different countries have different ways of doing it. You have inflation targeting. You have some people don't have inflation targeting necessarily, but they have a desired inflation rate that they would like to have. There's an argument nowadays to say that excessive money supply doesn't necessarily lead to inflation. It's basically because it's demand driven, and given the current economic situation that we're in. So, but various those are economic theories that have been played out. But from a central bank perspective, they have to make sure that they look at the economic data that's coming out and decide, okay, what are the banks asking for? What is the current situation? What does the economy need, right? And thereby connect and control different aspects of the financial sector so that they achieve that goal. So if you look at money supply, for example, money supply is basically defined as currency held by the public, and basically what people demand time. It could be currency notes, it could be demand deposits, savings deposits in a commercial bank. So that's what we call M2. So in other words, it's cash plus your deposits that you hold. So this is the process. I'm sure you all know this. Depositor, bank lends out 90% after keeping this reserve. Reserve lends participates with the bank. It goes to another institution. They lend out 90%. Another 10% is kept at the bank. So basically, what happens is there is a degree of money creation that takes place where the initial 100 gets leveraged many times, and basically it creates 171 out of 100 in this particular example. So it can go on and on and on like that. So there is a leveraging effect that takes place. There is a multiplier effect that takes place through a simple deposit. So when the bank decides on how much of money there is in circulation, they take into account this, central bank decides, they take into account this leverage effect, and they manage a few things around it to figure out, okay, how much of more money do we need to put into circulation. Along with that, they will manage in order to manage that, they will look at how much of M2 is out there, number one. Then they will look at how much of reserve requirement is. So currently our reserve requirement is what, 4% SRR? Is that correct?
No, so it's 2%.
2%. So, sorry, I lost track. So 2%. So we were at one time 10%, I remember. Yeah. So I'll ask you a question here. Why is it that our SRR was 10% is now down to 2%?
To liquidize the system more.
To what? Sorry?
Liquidize the system more.
So in other words, the central bank is saying, look, we are not restricting you, Mr. Bank. I used to keep you, I asked you, used to keep, tell you to keep 10% of your money that you got as deposit. Now I'm only asking you to keep 2%. Right? So how does that support the bank?
Increase liquidity.
The bank can basically now go out and lend 98% of the money that it borrows. In other words, where it had to earlier keep 10% aside in central bank earning 0 interest. Yeah. Now it has to keep only 2% with central bank in a non-interest bearing account. Yeah. So in how does that support the bank? It actually provides him the option of lending to a borrower at a cheaper rate than he would have lent earlier, or taking deposits at a higher rate than where he could have taken earlier. So I'll give you an example. Previously, if they were taking, say, in deposits at 5%, right, and they have to keep 10% as reserve, ideally, I would say, okay, 10%, I'm going to pay you only 4.5%, because I have to keep 10% of this deposit as I can't do anything with it. So I'm going to take away 10% of this and I'll quote you only 4.5%, because I could quote you 5, but I can't quote you 5 because I'm keeping 10% off as reserve. Yeah. Now I have to keep putting 2% off as reserve. So that's effectively about 0.1%, right? Now I can quote that depositor 4.9% instead of quoting him 4.5%. So I can pass on that benefit to the depositor by quoting him a slightly higher rate, because I can on-lend 98% of that deposit. Or if I don't want to charge it on the depositor, give the benefit, I can charge it. I can charge a lesser lending rate to the lender, basically. So what it effectively means is that you can lend more, and that lending translates to a higher deposit rate for depositors or lower lending rate for borrowers, and thereby increases the circulation of money in the system. This is just a graph giving you what the currency outstanding was in 2016 and 17, and it shows you how it's broken up in terms of reserve money, in terms of demand deposits, in terms of, you know, the currency circulation, time deposits, and the whole coordinated income, which comes to M2 at the end, consolidated broad money supply, which is line number 10. So why are we talking about money supply and, you know, all these things in this particular thing? This is not economics presentation, but why are we talking about this? Why this is not about you know, we're not talking in terms of this is talking from a treasury perspective. So we are trying to understand this so that we understand the impact on the amount of money in circulation in the economy on inflation, on economic growth, balance of payments, exchange rates, interest rates. Yeah. Ultimately, inflation will have an impact on interest rates. Growth levels will have an impact on interest rates. Balance of payments will have an impact on foreign exchange rates. Inflation will also have an impact on foreign exchange rate. Growth may have an impact on foreign exchange rates. So we are trying to learn this to understand, look, what should our view on exchange rates be? What should our view on interest rates be? And thereby, how should we manage the bank's liquidity situation? How should we manage the bank's overall risk the bank has? So basically, to control money supply, the bank will use few options. One is the SRR, which we just discussed. Second one is the bank rate. So basically, the bank rate is the rate at which the bank will lend, central bank will lend as the lender of last resort. So if you don't have liquidity and you want to go to central bank, where can you borrow at on a worst case scenario? And then open market operations, where basically the bank will buy and sell treasury bills, repo, reverse repo, etc., to manage the daily requirements of the bank. And that's the most commonly used day-to-day function of the central bank. Yeah, so this is what we just discussed. Any questions around this, Sarah? Before I move on. Pretty straightforward. Yeah. Okay. So the bank rate. Sorry, I don't know what the bank rate is now. I should have checked on it, but I don't know what the bank. Anybody knows what the bank rate is now?
It's 8.5.
8.5%. Okay, so right. So 8.5. It basically means that's the rate at which, if you are really stuck for money, and the lender, you can't borrow from the reverse repo window, you can't borrow from your counterparties, you don't have deposits coming to you, you can borrow at 8.5% from central bank. But I can tell you, it's not something that you really want to do. Because as soon as you start borrowing there, it gives a very bad signal to the market that, look, there's something really wrong. The bank has no access to funds. So like it says in this, it's a role as lender of last resort. Central bank, you have no option but to go there. So open market operations, the most widely used. So if you're looking at short-term funds, you have repo, reverse repo, your daily options, where you can pledge your treasury bills and borrow against them, or you can basically give money and have treasury bills pledged to you. That's a repo, reverse repo window. Standing facilities, so central bank standing facilities, where you can go out and borrow money from them. And swaps, where you can swap your dollars into rupees, rupees into dollars, etc., whatever foreign currency, even other between the foreign currency, to basically fund your requirement that you might have in a particular currency pair that you might know. So for example, right now, most of the local banks, like I mentioned, might need dollar funding. So they will go to another bank and say, look, I'll give you my rupees, give me my dollars, let's do a swap. And there will be an exchange rate determining buying and selling. I buy dollars from you at 200 rupees today, and I give you back the dollars at 201 in a month's time. The 1 rupee reflects the cost of him borrowing dollars for that month, basically. Yeah. So in the process, on day one, rupees are exchanged, he gets dollars. That guy has the rupees to do whatever he wants with. In a month's time, he gives rupees back and gets his dollars back, basically. The difference in the exchange rates reflects the premium or discount or whatever it is that you might be charging for lending the dollars. So often in Sri Lanka, rupee interest rates are higher than dollar interest rates. You should be getting paid for giving dollars to somebody and getting rupees, because you should be paying somebody for giving dollars and getting rupees, because you're getting the high yielding currency. But currently, because dollar interest rates effectively are higher in Sri Lanka, it's at par or might be even at a discount, meaning that you're actually paying to borrow dollars and give rupees to somebody, where it should be the other way around. You all did the section on foreign exchange and forwards and stuff with Nishant already, right?
Yes, sir.
So you all know how the swap and the forward calculations take place, right?
Yes.
Yeah, so it comes down to that. So the swap market is basically a way of managing liquidity from one FX to the other FX. And then you have the permanent basis, which is basically meaning permanent what you do. So you have treasury bills, you want liquidity, you just go and sell them. Or you have excess liquidity, you want to buy treasury bills, you want to, you know, pump up your asset portfolio, or you want to sort of invest in it because you feel interest rates are coming down, or whatever it might be, you go and buy outright treasury bills. So this is a bit dated in terms of the data, but you can see where our call money rates were in 2017. We had call money go as high as say 8.5%, come down as low as 7.5, and stay there in 2017. Currently, call money rates are, what are call money rates right now? Somebody in back office should know that.
It's around 4.5, 4 to 4.5.
So we are here. So you can see how lower interest rates have come from where we were a few years back. Yeah, it's around here. So all these curves will be down. So you can see that the standing corridor is where you borrow, repo, lend, and borrow from there. That's the corridor that was there then. This is where the call money rates are, which can go higher and lower than that. And as you can see, it usually trades around the high end of it if there's a liquidity shortage, and then at the lower if there's surplus liquidity there. And special deposit SDF rate is here.
It's 4.5 and 5.5.
4.5 and 5.5. That's right. Okay, that's it for the lesson. I'm just going to go through some questions here. But before that, any questions from you all on this part of the lesson? Okay, let's jump into the questions. Sorry, give the answers. Right. So the question is, the bank concentrates on two major operations which create a natural organization structure. What are they? More than one question, more than one answer. Simple one.
Taking money in and loaning money out.
Yeah.
A and C.
A and C. That's right. Simple as that. Okay. Liquidity versus illiquid depends on whether you have mismatch. What?
Assets and liabilities.
Okay. Anybody else?
It's assets and liability.
Yeah, correct.
C.
C. Okay.
Can I see the previous slide, sir?
Sure.
Slide number 51.
One, is it? One or two?
One. Okay, sir. Thanks.
Okay. Present value of each currency on the asset side minus the present value of each currency on the liability side is calculated to derive what?
Net exchange position.
Okay, you say D. Anybody else? That's right. So net exchange position, we touched on this. It basically takes into account all the assets you have at one point for one currency against another currency, and then basically compares it to all the liabilities you have on the same currency pair. And you say, okay, you are long dollars against rupees, or you are long sterling against dollars, or whatever it might be. And then you come to a net exchange position. That will give you whether you're surplus dollars. But remember, this is exchange. This is not just deposits. That's a very key thing that you have to understand. It is a exchange position, not an asset position, meaning that you have exchanged rupees into dollars, for example, or rupees into dollars or dollars into rupees in order to create that asset or liability. You're not just borrowed it. So for example, if I go to a bank and say, give me $100 million, the bank gives me $100 million, that sits as a liability on my books. That's not what I'm talking about, right? What I'm talking about is I have converted my rupees into dollars. Now I have dollars. I have converted my dollars into rupees. Now I have rupees. Taking all those conversions into those assets and liabilities and say, okay, this is my current situation. That is my net exchange position. If not, if you're taking your assets and liabilities separately and saying, I borrowed this much dollars, I borrowed, that's not, you're mixing it all up. This is the net exchange position takes in what the word says, exchange. When you have exchanged these two currency pairs, how much of liabilities and assets you have due to that exchanging of positions. That's why that position is monitored separately, because every time you exchange something, you're creating a exchange position. You're creating a risk. If I exchange dollars into rupees at 200 rupees, from that point onwards, if I have dollars in my hand, if the rate comes to 190, I run the risk of losing 10 rupees. If the rate goes to 110, I make a profit of 10 rupees. So I need to monitor whether I have surplus in relation as a result of that exchange, or I have a deficit as a result of that exchange. And then from there, take what my net exchange position is. Is that clear? Okay.
Yes, sir.
The period between the maturity date on funds that have been borrowed and the maturity date on funds that have been placed is called what?
Gap.
It's called a gap. Okay. Let's see. That's right. The microeconomic significance of liquidity management is the bank's ability to meet its obligations on time, loan department's ability to make loans, stability of the country's banking system, stability of the world economy. Microeconomic, not
Bank.
A.
sorry. Sorry, I
Bank's
didn't get
ability
it.
to
So one
meet
says
its obligation.
A, somebody else said something else. There was a lady, she mentioned something. Sorry, I didn't get your name. Okay, there was definitely another answer other than A. Somebody said something. Okay.
A and C.
A and C. No, only A. You know why? You're talking about microeconomic, not macro. So basically, you're talking from a very individual perspective, a micro perspective. What is the importance of managing liquidity? But from macro perspective, check the next question. Why is it important?
C.
Exactly. The central bank of each country usually mandates that a certain percentage of each bank's commercial deposit be retained as liquid assets. These funds are called what?
Answer B.
B. Anybody else?
SRR.
Yeah, so B. So here I must add in one more thing here. This is the central bank requirement, but you know about Basel 1, Basel 2, Basel 2.5, Basel 3, all that. There are liquidity requirements that are given, capital requirements that are given by that as well. So as much as this SRR will mandate how much of reserves that need to be maintained for liquidity, there are also other liquidity ratios that need to be maintained, liquidity contingency plans that need to be maintained, coming on a more longer term basis. This SRR is more to do with the more short-term liquidity requirement, not necessarily the bank's long-term liquidity health. Yeah, that you must understand. So this is not limited to the SRR. There are other ratios that also support the long-term liquidity and health of the balance sheet of a bank. The instrument used to control borrowing by commercial banks from the central bank is what?
Answer B.
B. Anybody else? The instrument used to A. A, B. Anybody else?
So
Look
they're
at what it
asking about
says.
instrument.
Yeah, they're asking about the instrument. Exactly what I want to say. They're
Then
not
it's a
asking.
reserve requirement. Sorry.
No, it's a discount rate. So basically, so what happens is this, right? The reserve requirement will basically tell you how much you can keep and on lend. Liquidity management is a function of the bank. Gapping also is something the bank does to manage its gap in its balance sheet. Central bank will use their lending rate. In here, it's called the discount rate to control what rate the bank can lend at, and also what rate they will be able to lend at. For example, when we say discount rate, they're talking about the reverse. They're talking about the central bank SFR and STR or whatever it is. That rate.
Standard deposit rate and standard lend.
Yes, exactly. They're looking at that and saying, okay, if we bring it down, we make it cheaper for the banks to borrow, and overall rates will come down. And the banks can borrow it from us at a cheaper rate, and we are encouraging lending. If you want lending rates to come down and for a banks to stop borrowing too much, we'll take the rates up from that perspective. That way, they control the borrowing by commercial banks from them, as well as regulate the interest rates in the market as well. So to control the borrowing, so now the reserve requirement will control how much the banks can lend to their clients. Not necessarily, but they can borrow from central bank at. The discount rate or the repo rate or reverse repo rate or STR, whatever you might call that rate, regulates the rate at which the central banks can borrow from central bank, and also then obviously based on that lend to their clients as well. Yeah.
So page number 54.
Sorry, I didn't get you.
Page number 54, 4 please.
454, okay. Yeah. Yes. 54, sorry.
54.
Yeah. I've missed that, is it?
Another. Okay, sir. Get now. Thank you.
Yeah. Right. Thank you very much. Any questions? Anything at all? We have a bit more time, but I wanted to just cover just this one set of slides today, so we've done it. Is the pace too much? Because I need your feedback on it, because like I said, unlike doing physical classes, I need to gauge your understanding also through this. So if you can tell me if the pace at which we did this is good enough or not too fast or whatever. Give me a second. That would be useful so that I understand whether it is too fast for you guys or not. And if there anything else that you would like to provide us feedback on this as well.
In this program, which modules are you doing, sir?
I'll be doing the treasury management
Only
one.
this
So
module.
treasury management, there we have about another, I would say about 4 to 5 on this, and then ALM, which is another about 3 or 4.
Okay.
So you're already fed up of me, is it? After one class?
No, it's okay, fine.
No, I'm just
Very,
kidding. I'm just kidding. Don't
very
worry.
good, yeah.
I'm just joking. Don't worry.
Small thing.
Yes, go ahead.
Yeah, in between the discussion, there was something called capital adequacy that we're talking about.
Yeah.
Is it something that you could explain now, or we'll be studying it in the future slides?
It won't be part of this course. It is basically what we are talking about is the bank maintaining a sufficient amount of capital as a reserve, as a requirement from the regulator. So, for example, I think our capital adequacy ratios in Sri Lanka are about 11 or 12%, basically. So, what it's saying is from the capital that you have got from your shareholders and whatever, you have to maintain that ratio in order to stay solvent as a bank. Yeah. So how you manage that ratio is obviously as a bank, you have to have different tiers of capital, tier 1, tier 2, or whatever it is. And that tier 1, tier 2 comes with the quality of assets that you put on and the quality of borrowings that you make. Right. So to raise tier 1 capital, you might go out and issue some debentures or whatever it might be, or you might have a rights issue or whatever it is to raise your tier 1 capital number. So in other words, take more money from your shareholders or your debt, right? So capital adequacy, you can do it in 2 ways. You can reduce the level of low quality assets you have by lending to high quality assets. So that way your absorption of capital is less because you're having good quality assets on your book, which is recognized as high quality assets. Or you can increase your capital by raising it through issuance of some sort and thereby increase your capital. So you have both ways, or you can do both. Right? So if you can't raise money, you will reduce the highly risky assets on your book. If you can raise money, you keep that. So by doing that, you maintain the ratio, capital adequacy ratio that you have. So this is not to do necessarily with liquidity, but this is to do with solvency, to make sure that as a bank, you are having sufficient capital buffers in place to manage the solvency of the institution, basically. Not necessarily short-term capital, not necessarily short-term liquidity requirements, sorry.
So this is, it's like a thing to monitor the worst case scenario of a bank, is it?
That's right. So if somebody has a capital adequacy ratio of like 8%, 7%, the regulator will not like it. And obviously, that's why I think when this IFRS stands, I'm not an accountant, so please don't hold me to this, but then IFRS standards and stuff came through, the banks needed to go out there and raise capital. Because obviously they have lent. It's easier to go out and raise capital than try and tell somebody, look, I want your money back, my money back from you, right? So, and you obviously make money by lending money. So you don't want to necessarily do that. So the banks at that time issued debentures, rights issues, so on, to raise capital, to support the new capital adequacy requirements that were coming through at that time.
Also, when it comes to corporate bonds, it refers to only listed debentures, is that so?
Sorry, tell me again. The corporate bonds.
When it comes to corporate bonds, it only refers to the listed debentures, is that so?
When you say it refers to, who are you speaking about?
Listen, sir, if we are to trade debentures if a corporate wants to get capital via debt, he will have to ultimately issue debentures. Is that so? Only debentures?
No. So they can issue commercial paper, short term. They can issue long term debentures. It doesn't necessarily have to be listed. I don't think it necessarily have to be listed, but most of them are listed. But from what I know, these debentures are not very liquid, unfortunately. So even if you list it on exchange, you don't see them being actively traded. But the shorter term commercial paper, not the longer ones, but the shorter term commercial paper, I think are a bit more liquid and are traded a bit more than the longer term debentures, basically.
So commercial paper, securitized paper, those are also traded in the secondary market, listed.
Of course, yeah. They're not listed necessarily, but they are traded in the secondary market, basically. So, for example, you as a bank could be issuing a commercial paper, right? And then you could sell it to somebody, and then that person could sell it to somebody else, and so on. It doesn't necessarily have to be listed, but it's a bill of exchange. It's a secondary market instrument that you can trade, basically.
Okay, not necessarily, because I was understanding if it is listed only, you can keep trading in the secondary market. It's
not really, not. You can always do it. Now, those days we used to physically, issue paper, which say a customer of ours wants to borrow, we used to issue the paper, and that paper we used to sit with the lender. The lender would go then and go it to somebody else, who will take that paper, endorse it, and give it to somebody else who will give money to him. It was not listed.
It's like so ultimately, so ultimately, at the initial time, if it was issued to client A, at the point of maturity, client B can come and claim it, no?
Yes, you can, as long as it's endorsed. Like if you look at a check, for example, how does a check work? You basically have it issued to a person. He can endorse it and give it to somebody else, right? Technically, then that guy give it to somebody else, endorse. At the end of it, the bank will look at the last endorsement and pay. Ideally, that should happen that way from a proper banking perspective. It's the same rule, basically.
Thank you.
But practically, I don't think it happens that way. I'll be very honest with you. It'll be very difficult given the current regulations and, you're trying to be security and all those things. Bank to be a little more careful, but theoretically, it can happen that way.
Because practically it doesn't happen because the risk factor, no?
Risk factor, exactly. Right. Any more questions? Okay, great. So same time next week. Like I said, we will continue in the same way. And we will probably be finishing the treasury management section in about 4 to 5 lessons, depending on how things work out. And so throughout the month of May, I probably will be I will be probably taking your classes. I doubt very much we will have physical classes given the situation again. So we will be working on this same format over the next few weeks as well. Yeah. Nice to meet you guys, and hopefully we can meet physically before the end of the year or sometime during the year, but let's talk next week as well.
Thank you, sir.
Thank you.
Thank you very much. Thank you.
Thank you very much, sir.
Thank you.